first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
So here's the state of play. We're taking everything in stride at the moment. Equity futures down only a third of 1%. No real drama here when it comes to tariffs. A new announcement, tariffs on steel and aluminum, but a key date, March 12th. They don't go into effect until then. So do we have time to negotiate this away? Do we have time to negotiate carve-outs here? Or does this actually happen in a month's time?
If you take a look at markets, they're saying, well, something might happen, but wake me when we're there, because right now we're not paying attention to what has been so many times before just noise.
I think when it comes to exemptions, Trump already mentioned Australia. You have to look at who the United States has a trade surplus with. That is really this guy's North Star. I said yesterday, some meetings start where the top line figure everyone needs to focus on is the trade deficit the U.S. has with that specific country. So maybe Australia could be saved. Not sure about the others unless they bring something forward that he really wants to get done.
It's a key story for us this morning. In the bond market at the moment, yields are a little bit higher, up by 2 or 3 basis points. The 10-year 4.52. And the surveillance this morning preparing for Powell.
The Fed's on hold, right? They are totally on hold right now. They're on ice. They may not move at all this year. It's probably a really high probability. Right now, the Fed is more likely to just sit on their hands. Over the long term, rates are meaningfully restrictive, right? Probably, easily 100 basis points too high. So that is the path of least resistance, but maybe not this year.
So here's the latest. Investigators, or rather investors, gauging the impact of tariffs ahead of testimony from Fed Chair Jay Powell and Capitol Hill. Leslie Falcone of UBS writing, we look for longer-term bull steepener with 2 Fed cuts in the second half of 2025. Leslie joins us now for more. Leslie, it's good to see you. Last time we caught up towards the end of last year, you were looking for, I think, 4 in 2025. What's changed things, the data or the prospect that policy might change too?
Well, we were looking for 4 prior to the December Fed meeting, and then we actually cut it back to that too. And obviously, growth was much greater than we expected, and inflation turned out to be a little bit more sticky. But we are still looking for 2 cuts, and we do think that this disinflation trend, while it might be stalled, it's not completely derailed. So we are looking for inflation to continue to come down, and more than likely, the Fed cuts in the second half of the year.
Is it because of policy, though, back to John's question, or is it because just there is more momentum in the underlying economy than a lot of people expected before December of last year?
Well, there's definitely more momentum. If you look at some of these GDP growth numbers, if you look at consumer spending in the fourth quarter, even the first quarter, Atlanta Fed now is at like 2.8%. So, and the labor market remains strong. So there is obviously growth has been this much stronger than anticipated. But I think when people say the Fed is on hold, that's pricing into the marketplace. I mean, the market this morning is only pricing in about 30, 35 basis points of cuts for 2025. So I think that, hold for longer is there. We just think the market's getting a little bit too hawkish right now, so we're still looking for 2 in the second half.
When you talk about a bull steepener, it kind of goes against what we're seeing right now in the market, to your point, and you say that the market's a little bit incorrect with its pricing in of policy staying where it is. There is this belief that in the short term, in 2-year and 5-year types of time frames, you're going to see inflation move up because of tariffs, because of policy, but over the longer term, you will see inflation come back down and you'll see this sense of slower growth. Do you reject that narrative, that scenario?
I don't. I think the market's doing exactly what we expect it to do. The bull steepener won't come until the Fed actually cuts. Having this flatter right now is what you would anticipate, given the tariffs that we're seeing, the fact that you mentioned earlier inflation expectations, and the break-evens, which is exactly the floor plan that we saw from Trump 1.0. So what happens is you have these inflation expectations rise. They take the cuts out. 2-year goes up. The curve flattens. But the latter part, when you actually see some of the growth impact, the Fed cuts and you bull steepen. So I think the path is exactly what we would expect.
But what if you do see material inflation with all these tariff concerns, but then also a tighter labor market potentially because of what Trump is doing on the immigration front? Is that what could upend your thesis for 2 cuts in the back half of the year?
Yeah, we're not looking for a stagflation scenario. I think that, the Fed is going to look at that long-term inflation scenario, which has been, fairly anchored. We don't think that inflation is going to stay as sticky as what people think. We do think this is one-time price increases that the Fed does look through. So we're not thinking right now, from what we've seen, unless it's organically grown, fundamentally consumer-driven inflation kind of reacceleration, we don't think it's going to alter the Fed's path.
What are you hoping to hear from Powell today?
I don't think we're going to hear very much. I think he's going to be questioned about inflation. There's no question. But remember, even in the December meeting, they pushed their target of 2% from 26 to 27. So they've pushed that out, right? And I think he's explained enough in terms of the recent commentary, which, the last Fed meeting was very, boring in my opinion. He's going to wait for the data. He's going to see what happens in terms of inflation. But I don't think that he's really going to alter his rhetoric that what we saw in the last Fed meeting.
When it comes to tariffs, I think a lot of economists would agree with you, a lot of economists on Wall Street, that the Federal Reserve would choose to look through any price level impact and see it as a one-off. What would constrain that is an important question, though, and Deutsche Bank say the following: their ability to do so could be constrained if inflation expectations begin to rise and/or the labour market re-emerges as an additional source of inflationary pressure. Have we had any evidence of that, seen any evidence of that in the data we got on Friday, on UMich, and in the jobs report?
Listen, the wage data that we got on Friday was actually stronger than expected, and I think when you think about the policies as a whole, we don't know the impact of, say, immigration, what that might have on the labor market or inflation. We don't know what some of these policy impacts are going to be. But we're still looking for, in our opinion, the labor market to stay strong and growth to stay above trend. We just don't think it's going to force them to completely, stay on the sidelines. And we especially don't think they're going to force a hike in the near term.
Constraining the bias to ease versus forcing a hike are 2 separate things, I think. Constraining the bias to ease, I think, would be sufficient to spook investors, which is why I think this price action that we got on Friday was so material off the back of what we saw in UMich, together with the wage report, the hotter-than-expected wages with inflation expectations inching higher, albeit not confirmed by the New York Fed's release yesterday. It's enough, it's sufficient just to keep people on edge.
Because there's no reason for the Fed to move. Right now, there has been no data that would really push the Fed off the shelf, where they're very happy to remain out of the fray, out of the political noise, and just saying pretty much nothing and being really boring. And so I think ultimately what you're going to get, and I think that your point is a salient one, which is the removal of the option of cutting or the potential for cutting is enough to spook this market. How much more would have to get priced in, or is that the fully priced scenario at this point?
Even spookier if you think growth is slowing. And Neil Dutcher of Renmac does. Neil writing this, and I repeated this a little bit earlier, so I'll share it with you again in case you missed it. He thinks growth is slowing. He's worried about that. I was reading his note that he put out yesterday, and he thinks growth is slowing while the Fed is playing a game of chicken with the Trump administration. That's problematic if you believe that's the case.
You can tell a different story depending on what sector you look at. He's looking at the housing sector, but you listen to what McDonald's said yesterday. They actually had an okay outlook. You saw a rally because they outperformed based on non-U.S. sales. But they said low-income consumers in the U.S. are still under pressure. And they said the overall market is pretty muted. The low-income segment really is still feeling it, and that is a significant portion of their customer base. So that type of commentary is enough to keep certain people on edge.
That's choiceful, translated. That's some real detail. I hate the word choiceful.
I hate it too.
That's the detail that I think we need to hear from these companies. Leslie, it's good to see you as always. Thanks for being here. Leslie Falconio there of UBS. Up next on the programme, we'll catch up with Stuart Kaiser of Citi, Bloomberg's Tyler Kendall, David Tinsley of the Bank of America Institute, and Kit Juice of SocGen on the latest out of Europe. The surprise so far, European outperformance in the equity market. Can that continue Can that continue? We'll ask Kip in about an hour from now. From New York City, this is Bloomberg.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot, by the
on
way.
beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably wouldn't
Bitcoin.
be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about. They fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
When we think about the potential for price impacts from something like a universal tariff, they could be quite large.
Some of these tariffs, they get put on and they just stick around for a while.
The Fed is probably going to stay on hold because they don't have a clear picture of where that's going.
We think that the Fed is likely not done with its rate cutting path in this cycle.
Taking a high quality approach at the factor level, I think that's the best way to navigate through this.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Equity futures on the S&P just about negative by 0.2% on the S&P 500. The second hour of Bloomberg Surveillance starts right now with equities just a little bit softer, going into quite a big 24 hours. Chairman Powell twice, once in front of the Senate, then in front of the House. He'll be on Capitol Hill facing a grilling. Big one down in the nation's capital. It's never really a grilling. We'll see what we get a little bit later. Then tomorrow morning, it's US CPI. Inflation in focus in a big way over the last week. Inflation expectations in the UMich survey on Friday just creeping a little bit higher. And the complaint you're hearing from consumers right now, consistently, actually, is about tariffs. And we got more tariffs overnight.
prospect of 25% on all steel and aluminum and the possibility of retaliatory tariffs coming from the European Union in particular. All of this goes to explain why we're seeing shorter-term inflation expectations in the market tick upward. You can see that in the 2-year and the 5-year inflation break-evens, and those are both at the highest levels in about 2 years. That's leading some people to think, exactly to your point, John, this is going to take away the need for the Fed to cut rates at any point in 2025.
I don't know about you, but 4 weeks into the administration, I'm already losing track of key dates. So this one's March 12th, right? March 12th for tariffs on steel and aluminum. So we've got about a month. About a month to work out whether we can negotiate this away or secure some big carve-outs for some downstream manufacturers who might be pretty disappointed about this announcement.
Well, it's a great point you made last hour, and this is what happened during Trump 1.0. This is what the Wall Street Journal editorial board talks about today, which I'm sure Trump is going to take AMAX. He gets very annoyed with these editorials, but they say is the strategy to harm U.S. manufacturers and workers, and they go on to talk about a company which produced roughly half of the nails made in the U.S., and after those steel tariffs took place in Trump 1.0, its sales plunged, and they had to lay off individuals. And then some people quit because the factory is going to have to close. Guess what happened at the end of the day? The Commerce Department came out and said, okay, you get an exemption because this is so important to the manufacturing base that actually the Trump administration is trying to boost.
I'm not going to editorialize. I'll let the Journal do that. It's just a statement of fact. More people work for downstream manufacturers than they do in steel production. There will be trade-offs. There always are, and this is going to be a trade-off if they go in this direction.
Back in the 2018 period, to Anne Marie's point, you saw industrial employment actually fall, and you saw industrial production in the U.S. fall after the implementation of certain tariffs. Is this time different if there are no carve-outs, if there is a more comprehensive plan? A lot of people are trying to understand this, but you have already Deutsche Bank coming out and increasing their expectation for CPI and just inflation more generally, should these tariffs come to fruition in their full form.
So the Europeans have got a lot to say, and the European Commission President Ursula von der Leyen had this to say: unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures. Now, I'm interested in the word unjustified versus justified. If you've got a 10% tariff on American autos and the US has a 2.5% tariff on European autos, are they justified to come up to 10? Can we have that conversation? Is that conversation available over the next few weeks?
It would be really great to know that. It would be great to know what was on the table to really take down the pressure, or what a justified tariff actually means. We don't know. It's a good point. And it's not fair to say, look, tariffs are bad and they're necessarily going to destroy economic growth, because tariffs went on during the first Trump administration. They stayed on through the Biden administration, and some people, including some of the big bank executives, say selective tariffs make a lot of sense. Question is, how do you come up with a framework as a business owner to understand what's going to get implemented and how it's going to trickle down?
Autos is one sector that's a huge gap when it comes to the tariffs. Then there's also farm products, another big gap when it comes to what Europeans put on U.S. farm products. These are grievances the president has. Another thing Oliver talked about, which I think is very timely, you have J.D. Vance right now, the vice president in Europe. You're going to have General Keith Kellogg going to the Munich Security Conference, Marco Rubio, Secretary of State. Maybe there's something to be said about energy and the industrial complex as well.
What did Macron say yesterday? Plug, baby, plug. Did you see that?
Oh, I didn't see that.
He quoted the president, drill, baby, drill, and he said, we can plug, baby, plug.
I don't think it landed.
It did not land. It was bizarre. It was absolutely, you can have a look. It's absolutely ridiculous. How does the president of France think that electricity is produced? And does he not think that Europeans need to take a more pragmatic approach to energy production?
It's actually a really good point. I mean, drill, baby, drill is you stick a drill in and you get oil out. Plug, baby, plug. You don't just plug it into the wall and then energy gets created.
When it comes to energy, who are they going to buy LNG from over the next few years?
Plug it into the wall.
I wish that wasn't a presentation. I wish it was a sit-down interview and someone was actually there asking questions about that, but I'm not sure that's catching on. Equity futures on the S&P right now, negative by 1/3%. Coming up this hour, Stuart Kaiser of Citi, ahead of Chair Powell's testimony. David Tinsley of the Bank of America Institute on the state of the US consumer, and Kit Jukes of SocGen as the EU says it will counter Trump tariffs. We begin this hour with stocks a little bit lower, going into Fed Chair Jay Powell's congressional testimony and Wednesday's CPI print. Stuart Kaiser of Citi writing, higher and harder to predict inflation would be modestly negative for stocks. The impact of that data may be muted by the FOMC's positive inflation messaging. Stuart joins us now for more. Stu, good to see you.
Hey, good morning.
Does Chairman Powell have a positive story to tell today?
I think he's going to try to spin it positively. I think he probably try to stay as much on script, relative to the January FOMC as he possibly can. They do take, UMich seriously, which is a little surprising to some people when they hear that, but they do take that seriously. The wages data he's going to have to acknowledge. But I think in general, they're going to, repeat the strong underlying growth narrative, strong Atlanta GDP, unemployment rate, looks good. And, they've been very selective about which inflation metric they choose to make sure it's the best of the bunch. So, yeah, I would expect them to try to spin things pretty positive.
Let's be selective. Let's take the data from Friday. Wages a bit hotter than expected. Average hourly earnings came in with an upside surprise. Then we had UMich. UMich, the outlook for inflation ticking higher, consumer sentiment a bit lower at the same time. When you take those data points, is that sufficient to constrain the easing bias that he still communicated at the last news conference?
I don't think it's enough to change their message just yet. I mean, that average hourly, we also had a big upside surprise last January, so there may be a little bit of seasonality in that. UMich can get revised. That's a survey of like less than 500 consumers trying to predict inflation over the next 5 to 10 years. So I think a little bit of a grain of salt probably has to be taken with that data. But I mean, he'll acknowledge it, but I don't think it's enough to change where their base case is right now.
I want to dig into and have you elaborate a little bit on this line that you said that John read. The impact of that data may be muted by the FOMC's positive inflation messaging. How much do you think this market is baking in the expectation that this Fed has an easing bias that is going to overcome any one-off noisy inflationary print like what we got on Friday?
Look, I mean, the market's pretty much been pinned at 2 cuts for the rest of the year for, the last month or so. So right now, the market, I think, is seeing the incoming data. It's hearing what the Fed is saying, and they're taking that, at face value and trying to keep it in place. I think the market believes the Fed has a cutting bias. I think, to your comments earlier, the thing that's going to get them off that cutting bias that's going to be negative for markets is inflation data. I just don't expect the Fed to really raise that red flag just yet. So, yeah, I think the market is bought into 2 cuts this year, the same way the Fed is.
Does inflation data over the next 2 to 5 years really affect what the Fed does now versus, say, a 10-year inflation expectation? Because we are seeing 2-year and 5-year inflation expectations tick up in market expectations.
Yeah, I mean, the 2 and the 5 are probably moving a lot because of the tariff risks. The question is going to be, does the Fed look past that and assume this is just a one-off or sort of step function? You don't change policy to deal with sort of a one-off price impulse. In that case, I think your real risk is, do you get a feedback of retaliatory tariffs? And I think that is the thing that would probably really change the Fed's stance most directly, is if China and Europe start to, play tit for tat on the tariffs and you start to now get something that is more than just a one-off. It looks like something that might be persistent and larger than the market expected.
In the meantime, people are looking through this, and you're seeing this broadening out in the equity performance, with some of the stocks performing best that are more susceptible to the idea of the Fed not cutting rates as expected. Do you think that can continue if you do get some sort of upside surprise in inflation, or do you think that that is really subject to potential disruption?
It's definitely subject to disruption. I think, it feels like the market, since the FOMC, has traded kind of higher for longer again, which is what we were trading in the first half of last year. That was generally not good for smaller cap stocks. It was not good for lower quality stocks. It was really something that benefited large cap and growth, which is the part of the market that we still think, you should be invested in. So, yeah, I think there is a risk there that you sort of had. The Trump sentiment trade really was, let's get into these smaller cap, lower quality stocks. Unfortunately, those stocks don't work well in a higher for longer environment, or at least the market has told you we're not going to own those in a higher for longer environment. So I do think there's some friction there, and I think that broadening out, if you were to get cuts priced out, especially for an inflation reason, would really be negatively impactful on those types of stocks. Yeah.
From a policy standpoint, if you want to see the market broaden out, do we need to talk more about what's going on the other side of Pennsylvania Avenue, which is the tax cuts, deregulation?
Yeah, I think tax cuts, dereg, are huge. Obviously, just a generally positive growth environment. I mean, the broadening trade, which is something like we're sympathetic to the story behind. The problem is, it seems like there's a pretty narrow range of data outcomes in which that trade can actually work. You need growth to be solid, but it can't be so strong that you're pushing out the rate cuts, because that's sort of a headwind from them from a refinancing perspective. If growth slows down, you don't want to be in the small cap stock. So it's a very interesting trade, and you could tell a nice story about it. We just think there's sort of a narrow corridor of macroeconomic data that it actually works in. And yes, you do need tax cuts and deregulation, I think, is a necessary condition.
So it sounds like the market's just treading water. What do you do?
I mean, from our perspective, you want to be in large cap and growth as sort of your core position, and then you need to trade the themes and the sectors that are most impacted by this. The problem is the narrative flips and flops, every day. So it's kind of, I would say
that's going to be the case for 4 years.
I agree, and John said 4 weeks into the administration. I think it's more like 2, but no, I think that's the case. And people are getting a reminder of what it's like. We highlighted in our weekly over the weekend. Mondays are now back in play. You can't carry risk into the weekend either. So, I think you have to have your core position. I think investors are actively trading event risk. From an options perspective, if things seem calm, you buy options then, because to your point, they're not going to be calm for long. And, I think if I had to highlight one thing that's been really resilient, it's banks. The banks in the financial sector is a part of the market that people are comfortable owning. It benefits from growth. It benefits from dereg. It's domestically facing. It's not going to get tariffed. And he might even allow them to bank in Canada if he gets his way with these tariffs, right?
It's impressive, the run that we've seen in the financials. Weekends are back in play too. No longer at the beach in Delaware, getting things done. It's been so busy the last few weeks. It's been remarkable.
And most journalists now are working weekends, so.
I don't feel sorry for the people who've got to work the weekend after the 4 years they just had.
It's fair. It's a fair point, John.
I'll leave that one there. Stuart Kaiser of Citi is going to be sticking with us. Stuart, it's good to see you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration has challenged a judge's order blocking Doge from accessing Treasury payment systems. The DOJ argued the judge's order prevents Treasury Secretary Bessent from doing his job. A hearing on a longer-lasting injunction against Doge access is set for Friday. Meanwhile, Morgan Stanley is looking to sell $3 billion of debt related to the X social media platform. The bank led a sale of more than $5 billion of the debt last week, with investors betting on Elon Musk's close ties to the White House. The current tranche is expected to price at 98 cents on the dollar or more and pay an interest rate of 9.5%. The Philadelphia Eagles Super Bowl win over the Kansas City Chiefs drew a record TV audience. Initial figures from Fox show 126 million viewers tuned into the game. That's a 2.1% increase from last year. This was the first time the big game was available on a streaming service. 13.6 million viewers watched via Fox's free service, Tubi. And that's your Bloomberg Brief. John.
Just fantastic numbers, Danny. Appreciate it. Thank you. More from Danny in about 30 minutes. Up next on the program, more tariffs on the way.
We'll be talking about other subjects like cars. We'll be talking about drugs and pharmaceuticals. We'll be discussing chips. America is going to be stronger than it ever was before.
There's a lot to play for, that's for sure. Bloomberg's Tyler Kender will break it down live from Washington, D.C. in just a moment. From New York City, good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Chairman Powell coming up at 10 a.m. Eastern Time in front of the Senate Banking Committee. This just dropping from Andrew Honhorst and the team over at Citi. We expect Chair Powell to reiterate that policy rates are in a good place and that there is no urgency to adjust them in today's congressional testimony. So Andrew and the team teeing up a snooze fest a little bit later on monetary policy.
I'd like to find somebody who is not teeing up a snooze fest. If you are not teeing up a snooze fest, I think this is going to be a fascinating two-day hearing. Please call in.
Anne-Marie is excited about it. In the bond market right now, yields are higher.
I'm not. Just rewatch the Fed press conference.
I don't think anyone thought you were. Up by 3 basis points, but thanks for clarifying. The 10-year, 452.92. Under surveillance this morning, more tariffs on the way.
We're going to be meeting over the next 4-week period. We'll be talking about other subjects like cars. We'll be talking about drugs and pharmaceuticals. We'll be discussing chips, all which will bring in a lot of jobs into our country. Cars is going to be a very big one and a very important one. And America is going to be stronger than it ever was before.
There's more to come. Here's the latest. President Trump ordering 25% tariffs on imports of steel and aluminum from all countries. Trump indicating the tariffs could be expanded to impact a range of key sectors. Joining us now from the nation's capital is Bloomberg's Tyler Kendall. So, Tyler, let's start with the latest. The key date for this announcement, I believe, is March 12th. What is the potential for carve-outs? That's a conversation we've had all morning. What's the president said?
Right. Well, good morning, John. We know that President Trump says no exceptions or exemptions, though, as you've been discussing. He did leave open the door for Australia potentially here, citing how they import a large amount of U.S.-made aircraft. But as you said, March 12th is really that date that we're going to be watching to see if any additional calls or visits get added to the White House's docket to see if any negotiations can get underway. But what is different about these tariff threats compared to previous ones is that they're not necessarily linked to another policy priority for President Trump, such as immigration. Rather, the White House is insisting that this is about rebalancing trade. And what that could mean is that it could make negotiations a little more difficult, particularly as President Trump says that he would like to revitalize these domestic industries. We know that U.S. net imports make up about 4/5 of the aluminum demand in this country, about 1/5 of the steel demand, according to an analysis by Morgan Stanley that we've been citing. And this really is an issue that both sides of the aisle have tried to capitalize on. You'll recall, actually, on election eve, something similar between the two candidates is that they spent some of their final hours campaigning in Pittsburgh, of course, considered to be an epicenter when it comes to U.S. steel production and workers. John, while producers, of course, have largely applauded this move, we'll be watching those manufacturers, particularly those impacted by those downstream tariffs that are now being rolled into this, and whether or not they give us indications on how this will impact American consumers, which could pose politically problematic for President Trump, considering he campaigned heavily on lowering costs.
Tyler, yesterday in the Oval Office, Trump said that reciprocal tariffs are also coming. Any color and detail on when we can expect those and what they may mean?
Right, still waiting on details on that. I will say that Bloomberg Economics, for example, said that emerging economies could be most impacted here. And it's interesting to point out that India's Prime Minister Modi will be here in Washington later this week, is expected to meet at the White House. And Bloomberg News already reporting that that India's top importer of oil is already looking at how they could expand U.S. imports of LNG. That's a similar storyline that we saw when Japan's Prime Minister was also here in Washington last week, saying that they would boost imports of U.S. LNG. So what sort of negotiations could already be underway as we look for these reciprocal tariffs that at this point, President Trump says that no one will be exempted from? I did have the chance to speak to one Republican aide that said when it comes to reciprocal tariffs, these aren't necessarily surprising, considering that we saw President Trump float these universal tariffs, and potentially reciprocal tariffs could be used in a way to kind of make good on that campaign threat of across the board impacting multiple countries.
He's been very consistent about it, that's for sure. Tyler Kendall from Washington, D.C. Tyler, appreciate it. Stuart Kaiser of Citi is still with us. Stu, if we go back to the first year of this president's first term, we had this synchronized global growth story led by places like emerging markets. This time around, we've started to see Europe outperform again, a rest of the world story outperform a very dominant U.S. story. I just wonder how much longer that can last, given that the tariff story didn't come until 2018 last time around. So we have the benefit of that not existing in 17. This time feels a bit different.
Yeah, the sequencing is definitely different. By the time you were doing tariffs back then, you had already done the tax cuts, so you kind of had that positive kind of story behind you. In terms of European outperformance, I think that has a lot more to do with positioning and sentiment than it has to actually do with fundamentals. European growth hasn't been that great. The earnings growth in Europe is, a fraction of what you're going to get in the U.S. So, I think for European equities to continue to outperform, it really has a lot to do with sentiment and positioning. The positioning seems like it's been cleaned up a little bit. On the sentiment side, obviously, Ukraine has come up as a really big potential kind of driver of that as well. So I think there's still room here, but it's not going to come from fundamentals. It's probably going to have to come from risk premium.
How much are U.S. equity traders pricing in the risk of tariffs?
It's priced. I think it's viewed as, as Amber said, this is ongoing. This is going to be something that happens. Our various tariff baskets have, kind of either sold off or rallied, depending on how you want to look at it. And now they're just kind of in a holding pattern. So I think, the base case coming into me, I thought people were assuming a 10% across the board tariff or something that looked like that once you sort of measured all the pluses and minuses. Week after the inauguration, everything seemed really good. Markets rallied. Then the next week you got, I think, bigger than expected tariff announcements, which really disrupted positioning. So there's an assumption there will be tariffs. I think people initially were hoping it would be better than feared, and now I guess they're really just not too sure. So,
well, and when you say not too sure, I was looking at this Bank of America research piece that came out this morning, and the big question was, is policy uncertainty underpriced? And I was looking at that and thinking, okay, VIX really hasn't broken out. Yes, you're seeing gold reach record highs, but the market has been fairly sanguine. Do you think that there should be more of a pricing in of this inherent volatility and uncertainty that's a feature of this administration?
Not necessarily, to be honest with you. I think what the market is doing is pricing it very locally. There's a premium price for Powell and CPI tomorrow. There's a lot of risk priced in for NVIDIA. In between those days, the market is treating them as quote-unquote normal days. I mean, if you remember back to 2017 was the lowest volatility year we had since the mid-60s, and that was the first year of a Trump administration. So I think the idea that baseline volatility is higher just because Trump is in place, I don't think is correct. I think to get that higher baseline volatility, to John's point, you're going to need the growth data to start to come off. If you have a solid growth environment, then I think what you're going to have is relatively low baseline volatility and a lot of event risk. So I think what that means, you need to own weekend risk. You need to own, economic data risk. If there is a press conference or a vote in the Senate or something like that, you need to own that risk. But day to day, I don't necessarily think it's going to be higher volatility unless the growth stuff starts to crumble.
What does the Fed do with this if they're going to continuously also live in this state of uncertainty? How do they consider cutting, even if the economy is slowing?
I think you guys made a great point earlier. You could have the Fed between a little bit of a rock and a hard place here. If you cap federal hiring, or if you start to get some layoffs, unemployment rate ticks higher, then you've got sort of this inflationary impulse on the tariff side. Yeah, it could put the Fed in a really tricky spot. I think they've been very clear that unless a tariff is announced and implemented, it's not going to be part of their sort of policy outlook. But even Chair Powell's admitted that some members, they'll include a little tariff, just in case. So I think it puts the Fed a little bit between the rock and a hard place if the data evolves in that way. But for now, they're just going to have to, I think, really focus on the data. And then in the background, hopefully they're doing a lot of scenario analysis to deal with it. But yeah, I mean, look, their message is clear. They think, unemployment rate is going to stay about where it is. Inflation is going to be coming down. They're going to get a couple cuts in. And unless and until these are facts as opposed to proposals, I think they're just going to kind of sit on their hands a bit.
It's been really difficult to find out which Fed officials included a little bit of tariff. We've heard from quite a few of them. We spoke to one. They won't give you anything.
Nobody will acknowledge that they were the ones that were pricing in a little bit of tariff.
Why do you think that's the case? They're worried about accusations of political bias? What do you think
Absolutely.
it's about?
Of course.
Yeah, to get truthed, probably nonstop by maybe the President of the United States,
Do you think we get a little bit of that in this hearing later today and again tomorrow?
I think at a certain point, if the tariff proposals have been floated out there, it gets harder and harder for the Fed chair to say, we don't know what's going on. We can't assume or speculate, because you can. You have some proposals. So you have economists at major U.S. banks coming up with scenario analysis and figuring out what that would look like. I'm sure the Fed is doing the same.
Well, not just proposals. China tariffs are in place, and the tit for tat's back in place. So we actually have something tangible that Jay Powell can maybe speak to today.
China's still not in a good place. We heard from the Kering CEO a little bit earlier on this morning. No improvement in Chinese demand. not just for the quarter, for the year. Now we can sit here and say that maybe that's a Gucci problem, not a luxury problem, not a China problem, but that's not a good headline to read about the world's second largest economy.
Especially when you look at sales dropping 24% from 2013 levels, which are 2023 levels, which already were somewhat suppressed. You're right. It could be a Gucci problem, and Anne-Marie can tell you all about the designer kerfuffle and what exactly is going on. That
They
said,
have big problems.
Hermes
That's a
is...
Gucci problem.
Well, Gucci is, you know, the crown jewel of Kering, and when Gucci goes, the whole company goes.
But we get Hermes reporting earnings on Friday. Do you get some kind of repeat of that, given some of the Chinese...
Don't think so. Hermes is in a better place. Personally,
Okay.
that's my
I'm
guess.
pleased with Dan with that. Is that, have you got a price target on a stock? Done? No, okay. Stuart, it's good to see you. Stuart Kaiser of Citi. Up next, David Tinsley of the Bank of America Institute on the state of the US consumer as we count you down to CPI, about 25 hours away from New York City. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Just a little bit softer this morning on the stock market. We're down 1/3 on the S&P 500. On the Nasdaq, we're negative by 0.5. On the Russell, we're down by 0.7. With 2 hours until the opening bell. Let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, could be a day in which we actually pay attention to tariffs. Here we go. Phillips 66. Elliott mounting their assault on Phillips 66. They already had a position. They've now built that to $2.5 billion. This is Elliott really reaching into the energy sector. Simplify the board. Deliver. They want to push Phillips 66 to deliver, do better. They targeted $3 billion of asset sales. You've only done 2. It's like a school report. Do better, or indeed, Elliott will push you. Meta, you talked about this exhaustive 17 sessions, 17% in 16 sessions, the longest winning streak. It's broken this morning. This one stock has delivered the longest winning streak on the Nasdaq since 1990. Doing a Jack Welch, cutting the bottom 5%. Roll it over, have a look at Coca-Cola. 55 cents is what they made. That beat the streak. 3.5-month high on the stock this morning. They raised prices by 9% in the quarter. So we're obviously scaling back at McDonald's, but you'll never script on your Coca-Cola. John.
Manus Cranny, thank you, sir. The stock is up by 3.4%. You noticed the same thing?
Well, this is the 11th straight quarter that that Coca-Cola, has raised its prices by 9% or more in the period. It just highlights how they're making up for pretty slow growth in the volume sales with price increases, and how they're still able to do so, even though we heard from McDonald's that the lower income consumer is being much more choiceful.
This is a part of the, and I love that word, don't at all. This is a bigger part of the tariff conversation. If the exporters don't take it on the chin, if we find out that this is going to end up with a company that's got to sell on to the end consumer, and they can't ultimately pass it on to consumers, and they've got to put it through margins, and then cut costs elsewhere, and then it goes into labor and bad things happen. This is the question we're asking. Are we knocking on the door of the limit of consumer price tolerance or not? Or are we still seeing evidence here and there, and this might be, that perhaps there's still some tolerance still to come?
It's a great question. And is it different depending on the sector and depending on exactly where in the supply chain they end up getting some of the hit? Because you can see with Canadian oil and the pipelines, probably the margins will come in. But with the likes of consumer products, consumers have been conditioned to not totally know what price they're going to pay after the pandemic.
Coca-Cola up by about 3% at the pre-market. On our radar this morning, some top stories. President Trump ordering 25% tariffs on all steel and aluminum imports. The EU vowing retaliation. EU Commission President Ursula von der Leyen saying unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures.
So we don't know what those firm and proportionate countermeasures are. What we do know is things the president gets very frustrated with when it comes to the European Union. One, he doesn't think they spend enough on defense. He doesn't think they buy enough U.S. LNG, which in his first term, I think he called freedom molecules, and he wants to see more of them cross over the Atlantic into Europe. And then third, it's the autos. And you talked about this a lot, Jonathan. This massive gap when it comes to cars imported into Europe that are facing a 10% tariff, while Mercedes, Peugeots, for those random people that might have a Peugeot car in New York, have a 2.5% tariff. And that is the gap. And he said it yesterday, cars, it's coming.
We had a 206 back in the day. Do you know what that is?
I don't.
Okay, we won't pretend we're going to talk about cars anytime soon on this programme. It's a nice vehicle. You mentioned energy, getting lots of comments from the defenders of Macron's energy policy over in France. And I will say, granted, a lot of it comes from nuclear, and the French do not have the problem that the English and the Germans have with energy at the moment, granted. But plug, baby, plug is not going to land. And for the Europeans at White, there is a problem. You mentioned LNG. I think LNG is a very good point. I think it was one of our colleagues who said they'll be pushing on an open door if they want to buy more American LNG, or rather if the Americans want the Europeans to buy it, because the Europeans need it, because of disastrous foreign policy and a relationship with Russia that is totally broken down.
Let's just be clear. We're coming off a period where Joe Biden said you can't export LNG to Europe because that would increase prices back home. And now Donald Trump is saying, you guys better buy more. At the same time, I just looked it up. It's Molecules of U.S. Freedom is the new name for fossil fuels that Donald Trump would like to export.
What Emmanuel Macron should have said is one, yes, we will take those molecules of freedom that are drill, baby, drill, but it's fission, baby, fission.
Yes.
Not plug, baby, plug. Plug, baby, plug makes no sense. Fission, baby, fission would have been better.
Perfect. Do you want to work for the French administration?
No, thank you.
No. And they should address that to the Germans and maybe insert that somewhere into Merkel's memoir.
Yes, there was
that missing chapter that should have been in there.
There was at one point when Germany was shutting down nuclear, but restarting coal plants because of this foreign policy crisis where basically enslaving their entire manufacturing industry on cheap Russian fossil fuels.
Going to dig a hole with the Merkel supporters now. That chapter that should have been in the book, like everything I did wrong across 20 years.
Who's next?
That.
Who's next?
No
Macron?
one's next. No, we're done.
Yeah,
We're done.
Angela Merkel.
I try and stay out of British politics. Try and avoid that for the moment. That's
Well,
a very
I think that Keir Starmer is going to be coming to the United States soon. Yeah, so
Yes,
do you want
according
to
to
talk
my
about it?
reporting.
Yeah.
There's a trip in the works.
Was that your reporting?
It was.
Very cool.
Thank you so much.
When's he coming?
Trip in the works, I would say sometime this month, but we have Modi coming up, we have King Abdullah coming today, potentially the next few weeks. Keir Starmer will be the next one to head into the Oval
Decent
Office.
start for Starmer and Trump. There hasn't been too much animosity despite the differences in politics, so one to watch.
Is this you playing nice?
That's me playing nice.
Okay, all right, we're going to end there.
President Trump saying Israel should call off its ceasefire with Hamas if all hostages aren't returned this weekend. The president's comments coming after Hamas said it was indefinitely postponing the upcoming release. Trump saying if the hostages aren't returned, all bets are off and let hell break out.
He gave this a time frame. He said by 12 o'clock, and he said, I think that's appropriate time. On Saturday, he said Netanyahu can go his own way, but this is what my line in the sand is when it comes to Hamas. What was even more interesting part of that news conference is our Jenny Leonard was part of the pool there in the room, and she asked, because Trump has been talking about how Egypt and Jordan need to take in more Palestinians, she asked, well, would you be willing to withhold aid? Because the United States sends billions to Egypt and Jordan every year. And he said, conceivably, yeah, if they don't take in more Palestinians. That is why this meeting today with King Abdullah is going to be very challenging for the Jordanians.
It also raises this real tension for a lot of the leaders in Saudi Arabia and Jordan and some of the other allies of the United States and, frankly, allies of Israel, because a lot of people in their countries are very much for the Palestinian cause. And if they come out and support what Donald Trump is talking about, they could face significant backlash from their own population. So it's a very delicate dance that they're trying to orchestrate here.
Speaking of delicate dances and far less serious, but I think far more entertaining, the OpenAI CEO, Sam Altman, taking shots at Elon Musk after Musk offered to buy the nonprofit behind OpenAI for $97.4 billion.
OpenAI is not for sale. The OpenAI mission is not for sale. Elon tries all sorts of things for a long time. This is this week's episode. He's probably just trying to slow us down. He obviously is a competitor. He's working hard and he's raised a lot of money for XAI, and they're trying to compete with us. I wish he would just compete by building a better product, but I think there's been a lot of tactics, many, many lawsuits, all sorts of other crazy stuff. Now this. And we'll try to just put our head down and keep working.
Do you think Musk's approach then is from a position of insecurity about XAI?
Probably his whole life is from a position of insecurity. I feel for the guy. I don't think he's like a happy person. I do feel for him.
This got deeply personal. Fantastic job by our reporter, Tom McKenzie, out there on the ground over in Europe, interviewing Sam Altman, getting more and more personal as the days and weeks go by for these two individuals. He was pressed in that conversation by Tom about Elon Musk's close relationship with Donald Trump, the president, and if it's something that he should be worried about. And he basically responded, I'm not, but maybe I should be.
Yeah, well, or not, because think about what happened at inauguration. Elon Musk was there clapping, taking videos and selfies behind Donald Trump at the Capitol, in the rotunda. Where was Sam Altman? He was in the overflow room. He wasn't there center stage. But where was he the day after inauguration? In the Roosevelt room, standing next to the president announcing Stargate, something that I imagine Elon Musk would have loved to have been a part of.
Still very much on the inner circle, that's for sure. Look out for the full interview on Bloomberg.com, and of course, if you are a subscriber, on the Bloomberg terminal as well. Elsewhere, the US consumer in focus ahead of CPI data due out tomorrow. David Tinsley and the team over at Bank of America writing, we saw some chills in January's consumer spending, but saw no serious shadows. Spending per household was up a solid 1.9% year over year. I'm pleased to say that David joins us now. David, welcome to the program. Let's talk about the consumer in America and some of the headwinds that we thought would be in the data over the first month of this year. We had the LA wildfires. We had a very cold snap across the East Coast through January as well. David, do you see that in the data at all?
We do. I mean, what we see is that on the month, card spending dropped
0.4% over the US as a whole. But when you look across the regions, it was the South where we had particularly cold, chilly weather, which saw the biggest drop. That was down 0.9. Not so much of a story in the West. That was actually pretty much flat. But I think, yeah, basically, the dip in consumer spending in January is more or less a weather story. And if you look past that, I think we're still in pretty good shape.
David, do you see any shadows hovering over the creditworthiness of an increasing number of consumers at a time where they're eating into their savings and you're starting to see on the margins credit card delinquencies creeping up?
Well, we do see cost pressures, which do affect, a lot of consumers, and then obviously acutely some consumers in particular. So in the report today, we're focusing on auto loan repayments, and the price of used new cars has risen a lot. Obviously, the loan charges, the interest rates are well up on where they used to be, and payments across all generations, they're rising upwards of 5% year on year, bit firmer for younger millennials, I guess, as they kind of trade up in terms of their car they're owning. So there are those pressures away from card spending, and I think, that is from card spending, and I think, that is part of the story that for just some households, that's a little too much. But by and large, the household sector is in good shape.
Are you getting the sense, David, that a lot of consumers are pulling back if prices go up to a certain degree, that they are feeling a bit more strapped, and you're not going to see the kind of acceptance that you saw in 2022, for example, or 2023, when it came to some of the price hikes going around?
Well, that's a good question, and we're going to keep looking for that. I would say right now the answer is that there's not a lot of sign of that. So we did see an increase in grocery spending out in our data in January, and obviously we've seen so many stories around coffee, juice, orange juice, eggs, of course. So there are these cost pressures out there, and then, of course, tariffs adds a dimension in that story as well. And in the surveys, we've seen some consumers, really flagging price pressures particularly in durables and cars. So I think it's not obvious we're seeing that in the hard data yet, but we're certainly looking closely from here.
Yeah, you say no chills, no serious shadows. At some point, then, what do you consider the tariffs to be? Because we see some American consumer sentiment, like University of Michigan, saying there is a little bit of concern about maybe inflation ticking up because of things like tariffs.
Yeah, quite right. I mean, there is some concern over inflation ticking up. I guess what I'd say is, the US labor market is in pretty good shape across all generations. Earnings growth, after-tax earnings growth in our data is solid. Growing at, sort of upwards of 3% year on year or so. So I'm not dismissing, the risks out there, and the tariff situation is confused and confusing for us and for consumers, no doubt. But I think right now, until that crystallizes, that risk crystallizes, consumer spending looks pretty solid.
David, you alluded to this. I just want to finish on it. Credit stress, of course, rates are staying higher for a whole lot longer. Do you see any signs of credit stress emerging anywhere, maybe beyond the auto sector?
Well, I'd point to what, the New York Fed publishes there, and we have seen this rise in delinquency rates that the New York Fed cites for cards and for autos and stuff. So there are, around the picture, elements of credit stress. But I think for consumers as a whole, strong labor market growth, elevated savings and deposits, that's still translating into solid spending growth. So I think by and large, the situation is solid.
Let's hope it holds up. David, appreciate your time, sir. It's good to see you. David Tinsley there of the Bank of America Institute out of London this morning. We've all been surprised by how well this has held up over the last few years. The fact that we got interest rates to where we got them, we've only come back down 100 basis points, and still we're only talking about pockets of credit stress. We were thinking about way more than pockets of credit stress if rates had to stay this high for this long.
We have to go back to what happened during the pandemic, which was essentially a terming out of U.S. consumer and corporate debt, and all of that debt being transferred to the government balance sheet, right? I mean, that was essentially what happened, which made the economy a lot less interest rate sensitive. it raises a question about whether, going back to this whole idea of restrictivity, are we seeing restrictive rates at a time where consumers are managing through and Coca-Cola can raise prices by another 9%?
How much longer can we do this for? Apparently longer, based on what we're hearing. Equity futures right now in the S&P, negative by 0.25%, with an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Despite President Trump's insistence on zero exemptions for newly imposed tariffs on steel and aluminum, one country may get a carve-out. Australia's Prime Minister, Anthony Albanese, says that he made the case for an exemption in a phone call with Trump and says that the president agreed to consider it based on America's trade surplus with Australia. Elsewhere, the Trump administration has ordered federal prosecutors to drum their case against New York City Mayor Eric Adams. A memo sent by a high-ranking DOJ official claims the case against Adams was politically motivated. Adams was charged with accepting illegal campaign donations and taking luxury travel upgrades from Turkish nationals. He has pled not guilty and denied any wrongdoing. Coffee prices have climbed to a new record high as supply concerns continue to grow. Prices have more than doubled over the past year with tighter supplies from top grower Brazil. Roasters are warning that prices for consumers could jump in the coming months. And that's your brief. John.
Danny, thank you. Our columnist Javier Blas has done a fantastic job over the last few months covering that story, so check out his work if you can. On X, on Bloomberg.com, and of course on a Bloomberg terminal. Up next on the program, the EU snaps back.
I am certainly looking to see if kind of Europe is willing to do this. One of the big concerns that I hear from them is that maybe they offer up something and then Trump embarrasses them, which is absolutely part of the negotiating strategy.
Kit Jukes of SocGen joins us on the other side from New York City. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Euro dollar down for 3 consecutive days coming into today's session, bouncing back by 0.2%. The euro at the moment at about 103.26, with a lot of tariffs to think about in the coming weeks. Under surveillance this morning, the EU snaps back.
I am certainly looking to see if kind of Europe is willing to do this. One of the big concerns that I hear from them is that maybe they offer up something and then Trump embarrasses them, which is absolutely part of the negotiating strategy. If a country makes a deal, can they actually see Trump follow through with this, or does he come on top and do something different, which makes it hard to want to be the first one that lines up and tries to do something to stop this?
So here's the latest this morning. The European Union vowing a response to President Donald Trump's 25% tariff on steel and aluminum imports. European Commission President Ursula von der Leyen saying, quote, unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures. On this and more, Kit Jukes of SocGen joins us now. Kit, welcome to the programme, sir. Let's talk about this, the tariff war, and how much this is putting a lid on the euro and the FX market at the moment, from your perspective.
There's no doubt it's just something else putting the lid on it. We don't have enough growth. We don't have enough political momentum, whatever the right term for that is, here, and we have interest rates that are going to go on falling. But the biggest thing of all, frankly, is the growth differential between Europe and the United States. It's not getting smaller at this point in time. So this is going to hurt Europe as it goes through, for sure, in terms of competitiveness, and the European economy doesn't need it. So, yeah, we'll see where we go, but there's not a lot of reasons to make you buy the euro that come from Europe. Maybe after the German election something changes, but until then, it's really just a question of how much stronger the U.S. can make the dollar.
Which is ultimately the real question, Kit. And we saw that steady march upward, stronger at the end of last year, but it's faltered. The strong dollar trade has faltered in the past month or two. Part of this is just because people are worried there is no more oxygen left up at the top. Is that your view, too, that we're kind of bumping up the limits of dollar strength?
Yeah, I mean, look, foreigners own $65 trillion worth of U.S. assets at this point in time, which scares me enough on its own. The U.S. net international investment deficit is $23.6 trillion. So we European savers are all in on U.S. investment because you've got higher rates, faster growth, more attractive investments. How much more can you throw at that? Equally, 0.95 on Eurodollar was the level we reached in the middle of the biggest terms of trade shock that most of us have ever seen, and the first land war in most of our lifetimes. So 95 feels like an incredibly strong dollar, and we've just edged closer, and we can't quite make it. My fear is that we sort of nudge up against it, and each day I say we can't go that much further. But that's sort of where we are now, which is strong, staying strong. The picture doesn't change a great deal. The European side of the equation needs probably political change, economic momentum. Let's see if that comes from the German elections. And then we wait for one-off events like, a possible solution to the war in Ukraine and things like that can help. But in the meantime, we don't have enough growth. We don't have enough growth to not cut interest rates here, which Jay Powell may say the U.S. has enough growth not to cut interest rates much or at all. And we wait and see. And yeah, there's nothing special about parity, but we are just kind of, trading in a very, very, very low range for the euro.
So treading water as we await some sort of shift in the narrative on one side of the Atlantic or another. How much as a currency strategist are you focused on gold as sort of the other part of this story?
I bought my wife another gold necklace for Christmas because this is just so much thing to. I don't own enough gold. I don't come close to owning enough gold.
Necklace? Why didn't you get her a bar?
I've got to jump in, Kit. Does your wife know that you buy her gifts with a store of value in mind?
She was a political journalist at one point in her life, so she's pretty wise, and she knows what I do for a living. So
she sees right through it.
She likes it. She's fine with that. But yes, I should have been buying bars ages ago. It's the gold story in this particular environment is going to be pretty compelling, particularly, starting from the moment that the U.S. effectively, I don't know what the right term is, but weaponized the dollar in terms of, wanting to challenge people who do things they don't approve of. So there's more demand for gold at the moment than there is supply. There's enough inflation concern to keep it bid. I am not a gold expert in a million years. Otherwise, I would own more. But yes.
Well, Kit, you'll have another chance at
things.
getting your wife maybe a bar this Friday for Valentine's Day. But I would love to know, from your perspective, the upper range of where we could see euro-dollar trade if there was a swift response to ending the Ukraine war, especially as we have the Munich Security Conference and we have Keith Kellogg going over to Ukraine.
I think we get back up into the teens quite quickly, so back above 110, well, somewhere between there and 115. That seems pretty plausible to me on that event. I think if you want to get back to 120 and areas like that, we need to change the relative growth story. The US has got higher neutral rates, it's got higher trend growth. So all of those things are why euro-dollar has been coming down ever since the Fed started normalizing policy more than a decade ago. But Ukraine, back in the teens.
Kit, appreciate it, sir. Say hi to Mrs. Jukes. Kit Jukes of SocGen. I hope she's not watching. Not this morning, anyway. Kit, appreciate it. Thank you very much. Sure, it would sort out sentiment without a doubt, and Kit makes the argument that the euro would get back to the high teens, but the growth story, it's not going to address the energy issue beyond France. It's not going to help Germany. Unless you believe that if you manage to settle this war, that energy and energy trade begins to normalize, whatever that word means, I just don't see how it gets easier. Talk to people in Germany trying to set up a company right now, relying on the price of energy at the moment, which is just so expensive in certain parts of the continent at the moment.
Absolutely, so expensive. And when it comes to going back to normal, what does that even look like? There's sanctions on Russian energy. Do they then try to do deals with Russia once again? Does Nord Stream come into play? It's very unclear and doesn't look likely, at least at this moment.
But to Kit's point, just from a sentiment perspective, yeah, without a doubt, it would unleash some euro strength, but growth differentials, that's the key. You've got to close the gap between Europe and the US from the growth side.
And it's unclear exactly who or how they could do it, given that the government is sort of up in question in a number of these economies.
Yep. Up next on the programme, we'll catch up with Sinead Colden-Grant of BNY, IBM CEO Arvind Krishna in just a moment, and we'll speak to ITR Economics too. And Sarah Malik of Nuvi from New York City. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Why does this business model work? Because it's virgin space. It's never been done before. and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
probably
wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Ultimately, stocks have been a bit unsteady over the last couple of weeks, so volatility certainly is part of that discussion. We are a little concerned that there might end up being some negative economic effect because of all this uncertainty.
The good news is that not only has the market been fairly resilient, but the breadth within the market has been quite impressive too.
The U.S. is still front and center, so I think staying as domestic as possible is going to work.
We could see investors step back a little bit. That might give you an opportunistic time to come into the market, a time to really kind of step in to that weakness.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bound 90 minutes away. The third hour of Bloomberg Surveillance starts right now with equity futures near session lows, down about 1/3 on the S&P 500. Likewise on the Nasdaq 100, just a little bit softer there as well. We're down by 0.4, down by close to 0.5 on the Russell 2000. We'll keep returning to the calendar. The calendar for the next few days looks a little something like this. In front of the Senate Banking Committee later on this morning, the chairman of the Federal Reserve again tomorrow. So a double dose of Chairman Powell. He'll be in front of the House Financial Services Committee on Capitol Hill tomorrow morning. Before we get there, the big one tomorrow morning, CPI, then PPI on Thursday, then retail sales on Friday. And a major focal point, not just for Lisa anymore, but I think for all of us, the amount of debt supply we get this week. Might not be dramatic this week, but it's one to watch for the year ahead, that's for sure.
Especially when paired with CPI and this fear that maybe inflation is just starting to creep up a little bit in all the wrong ways, whether it has to do with eggs and coffee or whether it has to do with steel and aluminum. A real question here about at what point some of these auctions start to falter as people really try to game out the ungameable. Right now, pretty sanguine, and yet this is something that we'll be watching going forward.
It's ungameable because it's uncertain, and the market is viewing some of this as potentially a negotiating tool, but potentially it's not, which is one area where I think senators could press Jay Powell on and representatives tomorrow. The Chinese tariffs, the 10%, went into place. So yes, he clawed back a pause on Canada, Mexico. We're awaiting whether or not March 12th, the aluminum and steel are going to come on. We're waiting for the reciprocal ones. When it comes to China, those are in place, and maybe they can get something different from Jay Powell than what we heard from the press conference.
For the bond market specifically, a lot of investors that we've spoken to over the past week or so have taken some comfort from the words from Secretary Bessent over the last week. If you look at the bond market, and let's just take 10-year yields. Look at the whole curve. Front end's one story, back end's another. 10-year yields have fallen for 4 consecutive weeks. Yields have actually dropped as these tariffs have gone on. As the threat of additional tariffs have come forward, yields have actually been falling, not rising.
Scott Bessent is more important right now to the bond market than Fed Chair Jay Powell. And that, I think, is something that we've seen again and again, where he said that he looks at that 10-year Treasury yield. I'm more interested, actually, in the yield curve shape. The idea that in the short end, you see this idea of increasingly pricing out Fed rate cuts this year as you do get stickier price pressures for a variety of reasons. Longer term, it's less of an issue. And now it just goes to a growth story, to your point, and about whether this really starts to impede that expansion story.
Polar opposite at the end of 24. Exactly. We've had a curve flattening to start the year, that twist that you described. At the end of last year, we were talking about a steepener. lots of deficit spending, maybe inflation picking up, 10-year yield starts to pick up. Middle of January, where were we? 480? Dropped back since then, back into the 440s briefly.
If we've got Fed Chair Scott Bessent coming out and saying that he targets the 10-year Treasury yield, and that that's more important than the overnight rate that the Fed actually looks at, and if he's talking about the importance of not letting it get out of control and that he's not going to issue more debt on the long end, that's going to quiet a lot of people who had concerns.
If the president's watching this morning, you might think Fed Chair Scott Bessent's got a ring to it. You know, maybe that works.
You know, wait a week.
Maybe in the future. Maybe, who knows? Equity futures right now in the S&P, negative by 1/3%. We begin with our top story. Trade tensions escalate.
This is the beginning of making America rich again. We were being pummeled by both friend and foe alike. Essentially, we're putting on a 25% tariff without exception on all aluminum and all steel. And it's going to mean a lot of businesses are going to be opening in the United States.
The EU snapping back. The European Commission President Ursula von der Leyen saying unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures. Your team coverage starts right now with Bloomberg's Tyler Kendall in Washington and Ollie Crook in Berlin. Tyler, I want to come to you first of all. Share the date with us for when this is meant to happen and how avoidable some people think it might be.
Well, John, the date that we are looking for when it comes to the steel tariffs is March 12th. We're going to watch and see if any calls or visits get added to the White House's docket ahead of that date as these countries try to potentially look into some negotiations here. Now, we know the Trump administration often outlines three key uses when it comes to tariffs as a revenue raiser, a negotiating tactic, and rebalancing a trade. It is clear that the White House at this moment is trying to push that latter use as these steel tariffs start to come into play. Now, we're looking for potentially other tariffs to come into play here. March 12th is in 4 weeks. That is the same timeline that President Trump last night outlined in the Oval Office, that his administration could be looking into some other targeted tariffs against industries like autos, pharmaceuticals, and chips. And then also, of course, we are waiting on any news when it comes to potentially reciprocal tariffs that could be on the board. Last night, President Trump saying that it is simple in his view that, quote, if they charge us, we'll charge them. Again, likely not leaving open the door here when it comes to exemption. So still a lot of big questions, John, but one thing is for sure, this is moving relatively fast when you think about how President Trump's pick for Commerce Secretary, for example, Howard Lutnick, who he says will have purview over trade. Also, his USTR pick, Jamieson Greer, have yet to be confirmed by the U.S. Senate.
We're only going into the fourth week. I keep repeating that. Ollie, I want to go back to that quote from the EU Commission President. Unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures. Ollie, will they wait? Will they wait for reciprocal tariffs? Will they wait for the prospect of auto tariffs as well? How quickly is the EU willing to move?
Listen, I think the EU has been playing a very long waiting game when it comes to Donald Trump, and that's why their response is they're stressing that issue of both firmness but also proportionality. They want to see what is in the mind of Donald Trump. Again, every negotiation, as we know, begins with the price. The price that Donald Trump has set for the Europeans has not yet been disclosed. It could be any number of things, whether it's NATO spending at 5%, whether it's buying more fossil fuels. Could it be something around antitrust and not regulating U.S. companies more? Could it be something around Greenland? They really don't know. So I think what they want to do is understand first what it is he is after and what they are willing to compromise with. I think that part of the issue that the Europeans have is the issue that many of the other nations, the other trading partners are having with Donald Trump, is that if you do get these concessions and you get a delay to these tariffs, what is the sort of guarantee that this won't go even further next time and try to extract more? And that is going to be front and center for the Europeans. Again, steel is a relatively small amount of the trading relationship with the United States. Again, what Trump is trying to do is close that trading discrepancy. There is a $230 billion surplus from the EU and the United States. You know, steel, the biggest one that sells to the United States is Germany. It's about $3 billion. But again, this is going to be front and center, John, when we head down to Munich in just a couple of days, the Munich Security Conference, because that is going to be the first high-level meetings between the Trump administration, Marco Rubio, J.D. Vance, Keith Kellogg, and the rest of the Europeans here in Munich.
Can't wait for your coverage of it. Ollie, thank you, sir. Ollie Crook over in Berlin, Tyler Kendall in the nation's capital. That word justified. The North Star, you said it earlier on the program. I think you're just dead on. The North Star for the President of the United States is, okay, show me a deficit. How big is it? You're running a big surplus with us? We've got a problem. We need to do something about that. That's just the start. Do you equalize the average weighted tariff? Is that how you reciprocate? I don't think so. I think it goes product by product. If you listen to the President, he's talking about autos. It bugs him. He wants to do something about it. Whenever he talks about tariffs on the Europeans, he always goes back to autos. And for the Europeans at the moment, as we know, we've said repeatedly on this program, they're putting a 10% tariff on US autos. On the other side, the Americans have got a 2.5% tariff. Now, when I hear words like justified coming from the European side, the president can come out and justify that. And I'm not sure what their response would be. What would their response be?
Well, they'll have to come up with a response line by line by March 12th, well in advance of March 12th. The time frame is very short to get some sort of agreement if they're going to go line by line and come up with some new agreement and then figure out how to implement it at a time where you need to change shipping lanes, you need to understand how to increase production, you need to understand who's going to sell those vehicles. There's a whole ecosystem that goes around selling any product that has to get beefed up in order to meet some of the requirements that might be necessary for some of the provisions.
There is scope for negotiation. It's not all bad news. There's one obvious place, and it started as soon as the president won a second term. LNG. The president wants to drill, baby drill. He wants to sell energy to the rest of the world in a way that President Biden did not. Okay, that's the starting point.
And it happened immediately.
Ursula von der Leyen said what? Straight out of the gate.
Straight out of the gate. It wasn't even inauguration. It was after Trump won the election. She said, well, maybe we can buy some more American LNG. That was within 48 hours of Trump being elected because they know the pressure points. It's energy, it's autos, and it's defense, which is why the Munich Security Conference, as Oliver noted, is going to be really important this weekend.
Let's get to the market conversation. Joining us around the table, Sinead Colden-Grant of BNY. Sinead, good to see you.
Good to see you too, John.
Is this a problem for the market? Because at the moment, equities are doing okay, taking this in its stride. The DAX in Frankfurt, Germany is up by something like 10% so far this year. Is this a problem?
Well, there are a couple of things that I think we need to focus on here. The first is, and our view has always been China would be first when it came to tariffs, and we've seen that. The discussion on tariffs with the EU in particular, think about autos. Not all European autos are actually manufactured in the EU. A lot of them are manufactured here. It is a very big pain point when you consider what's actually happened to, for example, the German car industry, where they've seen such an influx of vehicles from China. They didn't have any tariffs in place, and the industry has, well, let's not say decimated, but it's been very badly hurt as a result. But look, there's been a lot of talk. We had tariffs for maybe a couple of hours on Mexico and Canada, and then they were lifted. There were more negotiations. We need to wait and see exactly what the details are here.
Are you basically saying that you would count all tariffs that are threatened against trading partners other than China as more smoke and mirrors than actuality? That seems to be how the market's treating it.
For now, I think that is the appropriate response because the details really matter here, right? They'll have sector impacts, they'll have individual name impacts, but we also want to think through to what it means for inflation potentially and how big of an impact could that be, because as we've seen and are seeing, the last mile of inflation getting back down to that 2% is really hard.
How would you know if this is just a one-time hit or it's more pervasive when it comes to inflation? Because a lot of the criticism for people who say tariffs don't work and it means longer inflation, we'll look back to Trump 1.0 and say, well, the Fed took it on the chin as just a one-time hit.
It's complicated. So there are a couple of things that can temper the impact. The first is last time around, we actually saw individual companies decide to take the impact of tariffs in their profit margin. So that's one way it can be dampened. We've got a pretty strong dollar that immediately mutes the impact. And then lastly, if consumers start to buy more domestically produced goods and you see that substitution effect, then the impact of tariffs is lessened.
We've covered a lot of ground in the last few minutes or so. Chairman Powell, absent from the conversation for the last 15 minutes. What are you expecting from him on day one and then again on day two? Is this a big event for you?
Look, we always listen to what Powell says because sometimes it's not what he says, it's what he doesn't say. The thing that we're really interested in is any commentary around how they're thinking about the timing of cuts. Because, look, they still do have an easing bias. They're going to be more data dependent. And tomorrow's CPI print is going to be really important because, look, a lot of companies just raise prices in January.
True. In some ways, maybe tomorrow's more interesting once we get that CPI report and then we hear from him in front of the House.
How he characterizes it and exactly what the metrics are, what the benchmark is for them to feel confident enough to cut rates. Does he essentially indicate that rate cuts are becoming a more remote possibility in 2025?
I'm not going to criticize everyone in the House, but sometimes the questions in the House are of a different caliber to the questions that take place in the Senate?
So we've been to
that
the
an upper chamber and there's a lower chamber for a reason.
All I know is that we've insulted the French leader,
no.
the German leader.
Not insulting everyone in the House.
But then the House, a different caliber.
A different caliber.
Yes, well, it's look.
Chairman French Hill is going to take issue with this tomorrow.
No, he's a good friend of mine, and I've got a lot of time for the chairman of the House Financial Services Committee. I'm just talking about
the pet
some
projects.
other individuals in the House that have pet projects. Exactly.
And so you start asking him about, you know, one program in this town.
Yeah, they want to make
state.
a YouTube video,
right?
To
And then
send out to constituents.
And we all agree.
It'll get much worse as we get closer to the midterm elections.
So this might be a good one. We'll see. Sinead Colin-Grant of BNY. Sinead, appreciate your time. Thank you. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump has officially pardoned disgraced ex-Illinois Governor Rod Blagojevich. In 2008, Blagojevich was accused of turning Illinois' government into a money-making operation for himself by trying to sell the U.S. Senate seat vacated by former President Barack Obama, amongst other things. He served 8 years in prison before Trump commuted his sentence during his first term. The president also made comments about his vice president. Trump told Fox News that he's not ready to name Vance as his successor, saying it's too early to make such a determination. He said Vance is very capable and that he's done a fantastic job so far. A group of investors led by Elon Musk offered to buy the nonprofit that controls OpenAI for $97.4 billion. OpenAI CEO Sam Altman responded on Musk's X, saying, "No, thank you." Speaking to Bloomberg earlier this morning, Altman fired the latest shot in the war of words between the two.
Probably his whole life is from a position of insecurity. I feel for the guy.
You feel for him?
I do, actually. I don't think he's like a happy person. I do feel for him.
As of yet, no response from Elon Musk. And that's your brief, John.
So odd how personal that got. So strange. Danny, thank you. Up next on the programme, the Morning Calls Plus, the IBM CEO, Arvind Krishna, at the World Government Summit in Dubai. We'll catch up with Jemana Basechi in just a moment. From New York City, this is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures a bit softer. We're down by a third of 1% on the S&P 500. The opening bell 1 hour and about 13 minutes away. Let's get you some morning calls. First up, JP Morgan cutting its price target on Dow to 150, citing concerns around increasing margin pressure. The stock's down 1%. Your second call from Citi, raising its price target on Walmart to 120, saying it expects fourth quarter earnings to beat expectations after a strong holiday season. That stock is up by a third of 1%. And finally, Oppenheimer initiating coverage on IBM with an outperform rating, expecting double-digit revenue growth in its software portfolio. That stock is up about 0.25%. Let's stick with IBM. Let's head to the World Government Summit in Dubai, where Bloomberg's Jumana Basechi is with a special guest. Jumana, over to you.
Guys, thanks for that. Yes, so joining me right now is the IBM CEO, Arvind Krishna. Great to have you with us here at the World Government Summit in the UAE, of all places. Look, I just want to start off with a question that I think is dominating the discussions these days, and that is vis-a-vis artificial intelligence. You can't be a U.S. tech company these days if you're not seen to have a growing presence in AI. How does innovation keep up with demand for a company like yours?
Look, I mean, innovation is our lifeblood. Let me start there. And I do think that AI is a transformative technology. So no company can be in tech without having to play a role in AI. If I look at the role that we want to play, we are focused on the B2B market. So we do not want to do B2C. So B2B means you've got to take advantage of an enterprise's private data. Here's a shocking statistic. Only 1% of enterprise data has found its way into any form of AI model so far. So that is the unlock that we want to do. And as we bring that private data into models, whether it's used to refine models or to construct unique use cases, it unlocks a huge amount of value for the enterprise.
Yeah, how has the arrival of DeepSeek disrupted the landscape for generative AI? Because it's a model that was produced with a much lower cost, but also equal utility as some of the larger language models. Is this a major game changer, do you think?
Actually, you see me smile because I think it's our validation. We've been on this point for a long time that you do not have to spend so much money to get these models. If you're willing to make fit-for-purpose models, we do believe that the cost should be in the millions and not in the hundreds of millions. And so how do you begin to distill models down to smaller sizes, get them unique for a purpose, and then run them at 2 to 3%, so 30 times cheaper than the big models, but as accurate and as good for a domain-specific task?
Do you think that, therefore, there could be a day of reckoning for some of these big tech companies spending billions and tens of billions, even $100 billion on CapEx spending plans these years?
That's probably beyond my ability to compute. Is it a day of reckoning? But I can tell you that we're going to find that the usage is going to explode as the cost comes down. So maybe there's enough quantity increase that all of it maps out in the right way.
Yeah, you've always been a big supporter of open source models. And I just wonder, in the case of DeepSeek, whether that actually served as a reason for the disruption to take place. Would we not have seen a DeepSeek come to the market had there not been open source models?
No, I don't believe so, because there are enough large models that people are building, not in the hundreds, but definitely in the tens. And it's hard to imagine that there's an ecosystem which doesn't have a large model to start from. Look, ideas tend to spread. This has been true for 2,000 years. People have written about this. Once there's an idea, it gets penned down, the idea spreads. Once an idea spreads, smart people everywhere can copy it.
Yeah. Let me ask you a question about regulation. I started off the interview asking you whether innovation can keep up with demand. Do you think regulation is actually keeping up with the innovation that we're seeing in artificial intelligence?
I'll actually go the other way around. Too much regulation early stifles innovation and then doesn't allow those companies and those nations where the regulation is heavy to succeed. We can always look at the example. I think that the EU is very good at lots of things, but sometimes the over-regulation is an inhibitor on innovation. And I think we should balance that. I think that balance is incredibly critical. And I talk about precision regulation as opposed to sort of blunt force regulation.
Yeah.
So be precise and take a risk-based approach where only the most risky activities are regulated. So in AI, that becomes the use cases. So yeah, be more careful around life or death activities, but allow innovation in customer service, in productivity for your programmers, in terms of what we're going to do around improving the customer experience, but maybe be more careful in life or death activities.
Yeah. Let me just ask you another question, which is also very important in the context of tech innovation, and that is the rise of quantum computing. I thought it was really interesting that in your Investor Day just a week ago, you said, well, you updated the quantum computing roadmap, and you said that your aim at demonstrating the first quantum computer by 2028, that's only 3 years away. People are a bit skeptical that that can be achieved in that timeline.
Fault-tolerant with error correction quantum computer in 28.
Yeah.
We actually have 13 quantum computers on the cloud today, actual quantum computers. Over 100 qubits, so not toys, really serious quantum computers. But we believe we're going to be on the roadmap to do that by 2028. and that is a commitment that we did make. But I also believe that quantum computers are going to unlock a lot of value. We think about $500 billion worth of value for our customers by the end of this decade. That's exciting. Materials, climate change, carbon sequestration, better fertilizers, better batteries, exciting areas.
Yeah, do you feel that because the world is so focused on one thing at a time, and this time, it's generative AI, we're perhaps not focusing enough on how quantum computing is actually going to disrupt our day-to-day lives? What are we actually looking at in a few years' time?
We can do our work, and when we get there, it'll be a moment, and that moment is going to be important. Our customers are pretty focused on it. We have 280 people, different companies and organizations who work with us on algorithms. The state of Chicago, Illinois in the United States just announced the National Quantum Algorithmic Center, where multiple universities, startups, large companies, national labs all play a role. They'll be running on our quantum computer. They'll probably get others as well if they exist and do that. I think that's the excitement that is there. But the fact that 280 institutions all around the world are busy learning how to use them tells me they'll be ready.
Yeah. Well, we're here in the UAE, and I know that you were in Saudi Arabia recently as well. What opportunities are you seeing in this part of the world for AI growth and growth in your business?
We are very bullish about our business in both these nations, both in Saudi Arabia and in the UAE. I think the appetite for digital innovation, both for government services and for the private sector, is incredible. I think both nations have woken up that tech can be a big part of their economy. If you look globally, it's 4 to 5%. I think both these nations want it to be 10%, and they're investing appropriately. And you can look at the services that are there in both countries that are enabled by technology. Their appetite for AI is massive. You look at the investment that is done in the UAE around MBZ UAI, around some of the Falcon models. You look ditto in Saudi Arabia, and you have the universities, and you have the Alam model. I think that speaks for itself.
Yeah, well, I'm sure we'll be seeing a lot more of you in the region then. Arvind Krishna, really good to chat to you. Guys, I'll hand it back to you. That was the IBM CEO speaking to us on the sidelines of the World Government Summit here in Dubai.
Hey, Jumana, thank you, appreciate it. Jumana Basechi there alongside the IBM CEO, Arvind Krishna there. Lots still to come. A little bit later this morning, Chairman Powell on Capitol Hill in front of the Senate Banking Committee. In just a moment, we'll catch up with Lauren Seidel-Baker of ITR Economics and Sarah Malik of Nuveen. From New York City, this is Bloomberg.
question. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
60 minutes until the opening bell. Equity futures at the moment just a little bit softer. We're down by 0.4% on the S&P. If you check out the Nasdaq 100, we're down there by 0.6. With some movers going into that opening bell, let's cross over to Manus Cranny for more. Morning, Manus.
Jonathan, good morning. You've got a nice bid for Phillips 66, the oil services company. Here you've got Elliott that took a chunk out of BP. Yesterday, a sizable position. Today, they're putting more pressure on Phillips 66. Deliver. We took a stake in you at the end of 2023. You made us promises. Step up, deliver to the plate. Step up and deliver the $3 billion worth of cuts that you promised. Coca-Cola, 55 cents, double nickel on the earnings. Stock is up 3.5%, 3.5-month high, raising prices by 9%. Nobody's looking cheap in the Coca-Cola shelf. Kellogg's, where are you on your cereal? Do you go brand or not? Right now, Kellogg's deliver a much better earnings per share on adjusted basis, 42 cents. But they're talking about a challenging environment. The higher prices that they are charging are not translating to more consumer buying. So it's a bit of a conundrum on the high level of the earnings per share versus the challenges that they see in the market. John.
Manus, that stock is up by more than 5%. Manus Cranny there, appreciate it. As we anticipate the opening bell at 9:30 Eastern Time, shortly after that, in front of the Senate Banking Committee, you will hear from Chairman Powell. Volume 1, Volume 2 is tomorrow in front of the House Financial Service Committee. Joining us now is Michael McKee, our economics and policy correspondent, for more. Mike, you're there. What are you looking out for?
Well, we're basically looking for Jay Powell to do a sort of greatest hits version of his oldies and not make a lot of news today. That's going to be the goal. He's basically going to be talking to the markets, talking past the president, talking past the members of the Senate, and trying to make sure that the markets realize that nothing is going to happen very quickly, and he doesn't want to move things around a lot. Obviously, he's going to be asked about the path of monetary policy, doesn't want to give a long-term forecast, meaning doesn't want to forecast anything longer than tomorrow, because they really don't know the details yet of what the president is going to do, all of them together, and what the effect on the economy is going to be. So his message is going to be simple. We're in good shape where we are with interest rates. We can go up if we need to. We can go down if we need to. And right now, the economy's in good shape, so we don't need to. We can sit here and try to figure things out. One thing I would point out to you in terms of market coverage of this is, of course, watch the dollar and then watch inflation break-evens over the next few days. We've seen the University of Michigan inflation expectations number jump over a one-year period. 1 year and 5 year market break-evens have also jumped over the last month, and markets are getting nervous that the Fed may not be able to hold out and might have to actually raise rates. Powell will maybe try to talk them down off of that.
Mike, Jay Powell has been incredibly practiced at dodging questions on tariffs and his response to different policies coming out of this administration. He's been less tested on what his view is on regulating the financial sector at a time where this administration has aggressively already made moves to deregulate a lot of the banking oversight. Do we have a sense, Mike, of how Jay Powell could respond to questions about whether they're on board with that and are doing similar moves on the Fed side?
I think he's going to talk about the strength of the banking system and the fact that it's in good shape and that they are reviewing what they should do. But with Michael Barr's resignation as vice president for supervision, the Fed said they were going to hold off until somebody is appointed to that job before they move forward. Probably means the end of the Basel III endgame, which would raise capital requirements for the biggest banks. So he'll try to take as neutral a stance as possible on that, given that it's going to be a flashpoint for both sides. Watch Elizabeth Warren in the hearing today. The other big one that he's going to be talking about, or be asked about at least, is DEI. The Fed is an independent agency, can do what it wants, but it tries to follow general administration directives, and they have taken down their websites about DEI. Remember, the whole Fed monetary policy process is based on the idea of running the economy hot to give the disadvantaged more chance of getting jobs. That could be an interesting discussion today.
Mike McKee, looking forward to it. Michael McKee there in Washington, D.C., ahead of the first day of testimony from Fed Chair Jay Powell in front of the Senate Banking Committee. The focus has got to be on banking regulation here. We might say softer touch. I think the banks would say sensible regulation is what they want to see. That's how they'd phrase things, right?
Sensible regulation at a time where they think that it went too far. That said, some of the moves that we've already seen from this Trump administration have been far beyond what anyone expected, including, at least temporarily, dismantling the Consumer Financial Bureau of Protection. So a real question here about whether the Fed will lean into that kind of vibe.
The bank regulation, one focus, inflation, another. Lawrence Seidel-Baker of ITR Economics weighing in on the inflation data this week, saying this: much of the recent rise in price levels has been driven by high shelter costs and sticky inflation. On the service side, fundamental economic factors point to an upcoming rise in inflation in the back half of 25 and maybe beyond. Lauren joins us now for more. Lauren, good to see you.
Thanks, great to be here.
Let's pick up on that quote. What's the source for that pickup in inflation? Where's that coming from?
Well, it's a number of fundamental factors. It's not just tariffs. It's not just these Trump policies. We see things like the velocity of money increasing. We see the money supply. This got a lot of attention when it was contracting. That's now on the uptick again. We just see gross treasury issuance. There is so much liquidity out there. In addition to the macro cycle really gaining steam, that demand is going to pull on prices.
In addition to 100 basis points of interest rate cuts from the Fed, is that contributing to this call at all?
You know, I wouldn't say that's directly contributing. Yes, 100 basis points at the margin, that's going to be stimulative. And whenever we see this uptick in activity, that is correlated with that heating up, right, in price levels. But a lot of these fundamental factors, they're kind of deeper. They're the boring stuff that we like to nerd out as economists on and see the real leading indicators. They are already in the books. So I see tariffs, I see some other Trump potential policies as upside risks to rising inflation. But the fundamentals, those have been in the books for a couple of years now.
Where are you seeing evidence that consumers are accepting the higher prices? We were pointing to Coca-Cola's 9% price increase, which marked the 11th straight quarter of more than 9% or 9% price increases. Where else are you seeing that consumers are accepting these?
Well, they don't want to accept them. We get a lot of pushback, and right now sentiment is really diverging on the consumer side. The interesting thing, the data do say that wages are actually outpacing consumer price inflation. So I see our consumer as having the ability to weather these higher prices, but you're right, they're trying to push back. They're being much more value conscious, whether that's looking for the lowest cost, maybe looking for the bargain brand versus the name brand, or just buying in bulk where you can save. So there's definitely a different mentality amongst the consumer, but retail sales are increasing even on a deflated basis. So we do see that the consumer is out there spending more, and broadly speaking, we have that comfort that we can continue to spend.
What do you say to people who look back to 2017, 2018, the last Trump administration when he came in, put tariffs on, and we didn't see rampant inflation? If anything, we saw slower sales and a little bit of a hit to growth. Why isn't that going to be the logical consequence of a whole host of these different proposals?
So tariffs, I do not expect to be absolutely clear that the day tariffs are put in place, we see that full price impact on imports. Now, what we saw during 2018 is, first of all, some front running, and we certainly see that today. These tariffs have been very well signaled, so importers are getting ahead of them, bringing in steel, aluminum, whatever else it may be. But at the end of the day, those tariffs are giving even domestic producers room to raise their prices, to take a little bit more margin. We saw that in 2018. It's just a longer effect. It takes more time to play out, partially because of this front running and partially just because those importers, they're going to absorb for a little while. They just can't do that indefinitely.
When it comes to tariffs, though, if Trump is always in this negotiating stance, potentially, are people just going to be front running constantly? Is that going to be the theme for 4 years?
I hope not for 4 years. It would be great to get some final information before that point. But I think for the intermediate term, yes, until tariffs are imposed, that's giving us that leeway, right? That lead time. If we do need to bring more in, we're starting to see inventories recover. We had an inventory cycle in the past couple of years. And so we definitely do see the momentum shifting back, bring things in addition to a lot of foreign direct investment flowing into the United States. So much re-onshoring is happening. That's going to be the other part of the story.
Are you considering rate hikes?
I would not be surprised if rate hikes are on the table by the end of this year. The Fed let inflation get away from them once. They really don't want to see that happen again this cycle. So I wouldn't be terribly surprised. I think their ability to cut deep into 2025 is going to be limited by this inflation picture.
Year-on-year comps through the first quarter could be quite favorable for them. How are they going to navigate that with everything you've said in mind that this could pick up again by the end of the year?
Well, the Fed, they don't always lead the cycle, so I think they could be responding. They'll never jump on just 1 month of data or even 1 quarter of data.
Let me jump in then. When do you think the wake-up call actually is? Let me put it that way.
There's
when do you
no
think the penny
threshold.
drops?
There's no threshold. There's no panic. But I think by mid-year, again, it's going to be several quarters of that kind of consistent grind and inflation higher.
Lauren, it's good to see you. Appreciate it. Lauren Seidel-Baker there of ITR Economics on the outlook. Not the first time we've heard the prospect of a rate hike maybe being in store later this year.
I'm thinking about your question, which is what's the trigger point? What's the wake-up call for the Federal Reserve to even put that back on the table, which would be hugely disruptive to markets, certainly according to positioning right now. And it goes back to Scott Bessent and that 10-year Treasury yield, especially with the amount of debt that the U.S. government has. If that starts to get away from the Fed, you can watch the space. I'm guessing that there will be some real action taken.
The focus is still on tariffs.
Yes.
I think for a lot of people on the street, the focus will shift to taxes pretty quickly once that conversation picks up and builds in the year ahead. Let's turn to Sarah Malik of Nuveen. Sarah joins us now for more on financial markets. Sarah, welcome to the program. I want to talk to you about Chairman Powell a little bit later on. We heard from an economist just there that we could be talking about rate hikes later this year. Would you expect to be having that conversation?
Well, I wouldn't take rate hikes off the table, but right now we are expecting for about 1 to 2 rate cuts this year. I mean, what markets are hoping is for the dust to settle on tech and also tariffs. So starting with technology, the concern here over tech earnings is the amount of spending that companies are doing on artificial intelligence and the impact that we've seen from DeepSeek and the lower cost there. And I think markets are nervous. Are U.S. tech companies overspending on artificial intelligence, and will we get the return on investment from that? On tariffs, the questions are around, is this a negotiation tactic? Are we going to have retaliation? And who's going to bear the burden of the higher cost of tariffs? I don't think it's just a negotiation tactic. I think we are going to see some retaliation, and I think producers and consumers will bear the cost of higher tariffs. And the question, of course, around that is what does that mean for inflation? If you look at history, tariffs tend to cause a one-time bump in inflation. Whether or not the Fed will look through that is yet for us to find out.
Sarah, we've gone over a lot of things, whether it's the tech world, we're talking about the tariffs and how it all goes together. What's your framework for how you filter out some of the news that you get every day to understand how to prioritize either the proposals from the White House, the earnings that we're getting, or the economic data?
Well, first we focus on fundamentals, and looking at fourth quarter earnings, we're wrapping up earnings season, and they're growing 12% year over year. So the U.S. economy does remain strong. But then you have to look at valuations, and here's an interesting tidbit for this year that I think most investors didn't expect. European markets are outperforming U.S. markets. So why is that? Well, we know European markets are cheaper, but that's because of the tech trade. Europe has much less exposure to tech, and tech has struggled this year. So you're seeing EU outperform the U.S., and that's also due to U.S. valuations. So we need to be conscious of the fact that U.S. markets are trading at a 20% premium. You might say that's deservedly so because of the strength of our economy. But going forward, of course, we have to think about this sticky inflation. What does that mean for the Fed? Can the economy continue to chug along with higher tariffs? Also, thinking about 2 other factors from the administration, taxes and deregulation, which are pro-growth for the U.S. So areas that we're looking at that we like are small caps. Small caps in the U.S., I think they'll perform better with tax cuts that are more positive for the U.S. economy, and deregulation should open up the M&A markets. That's good for small caps. So looking at those areas of the world where there's valuation support and fundamental support, I think that's going to be increasingly important this year.
That's a pretty controversial call, Sarah. We've had a lot of people come on the show and say that they really don't like small caps because they have a narrow pathway to really be successful. How do you push back against that at a time when a lot of people think it's a very real possibility that this Federal Reserve isn't going to cut rates and that you're not going to necessarily get the tax cuts and other pro-growth policies quickly enough to really give that boost to this sector?
Well, oftentimes you make the most money when you go against consensus. So I'm often pleased to hear that other people don't like that call. I think it's important not to just focus on valuations, because valuations can stay cheap or expensive for a long time unless you have a catalyst. And that's the key with small caps here. They're cheap, but finally they have that catalyst. And that is some of these policies from Trump that we expect. Tax cuts should help boost the U.S. economy, help the consumer continue to spend, and create some operating leverage for the economy. We saw manufacturing data start to pick up last week, so that's also strong for operating leverage for the economy, small caps that are more domestically oriented. Don't forget about the strong dollar, negative for multinationals, positive for domestic companies like small cap. And of course, finally, deregulation. I think that does help open up M&A, positive for small companies that larger companies tend to look to buy. So those are the catalysts there to help finally close that valuation gap between smaller and larger companies.
But are all catalysts created equal? We have tariffs today. Tax cuts, that's going to take months, especially when every congressman and congresswoman is king or queen of the Hill and having tons of demands on what gets put in this reconciliation package.
Well, I agree. I mean, we have talk about tariffs today, but it's still I think there's still a lot of negotiation left. We have to see what the retaliation looks like. And again, who's going to bear the burden of those tariffs? Is it going to be consumers or producers? But I do think tariffs are the wild card this year. It is what everybody is talking about. It could be a serious issue for the economy, and how the Fed reacts to that could be important. Our view is still, though, if it will get CPI and PPI data later this week, inflation is moderating. I think the Fed still has the room to cut 1 or 2 times this year, as long as inflation doesn't reaccelerate.
We mentioned when it comes to Europe and the tariffs, Ursula von der Leyen's statement this morning about how it's unjustified and it will not go unanswered, will trigger firm and proportionate countermeasures. You started this chat talking about how the EU market beat the United States. Do you still think that's possible for the rest of the year, given this potential tit for tat between Washington and Brussels?
I think an acceleration of retaliation and tariffs could be a headwind for EU. The offset for that, of course, will be what goes on with the technology sector with DeepSeek, lower cost access to artificial intelligence, and whether U.S. companies will be able to monetize their investments at the rate and degree that investors are hoping for. If the tech sort of negativity continues, I think that is positive for European markets, and they do, of course, have about a 40% discount versus U.S. markets. They do have valuation support there. A couple of the things that we haven't really talked about on this also that's happening this year is, first of all, the return of the retail investor. Last Tuesday was the 3rd biggest trading volume for retail investors in the past 3 years. So retail investors coming back in, I think that is good for small caps. So that's important there. And that also could be another driver for the markets. And then finally, everyone is talking about inflation and worried about it, but look at the 10-year settling now down around the 4.5% level. 10-year is also telling you bond markets are a little bit less concerned about inflation.
Bond yields have been pretty contained, that's for sure. Sarah Malik there of Nuveen, your 10-year bond yield. The nominal yield at the moment, 453.93. Yields are up by 4 basis points. Though we have seen inflation expectations just inch up just a little bit over the past few weeks.
It's on the front end. It's the idea of 1 year, 2 year, 5 year out, that kind of expectation. Inflation expectations are going up. Deutsche Bank just put out this wonderful series of charts saying the U.S. has tolerated the erosion of domestic manufacturing in exchange for access to cheap goods. But this game seems to be up. And it goes back to the idea that if you excise the likes of cheap goods from China from the U.S. economy, do you end up with a structurally higher inflationary environment? And we have to go back to thinking about that
It's
as well.
a point that Mohammed Al-Erian has made repeatedly on this program over the years. As for Europe versus the United States, we've heard from a few voices already this morning. We've seen a squeeze. And we said at the end of 2024, how little needs to go right to engineer a squeeze, a position squeeze, to get something more sustainable. Kit talked about this massive long position we've built up in dollar-denominated assets over the last decade plus. To rebalance that, you need to rebalance growth differentials. Something needs to improve in Europe, in China, and I'm not sure we're seeing that just yet. Maybe we will, but we're not seeing much evidence of it at the moment, that's for sure.
That could be the shock. And Amory, you raised the issue of some sort of resolution to the Ukraine-Russia war, although it isn't just energy. It does raise a question about some of the leadership and the leadership changes that you get in Europe, especially on the heels of the Draghi report.
Well, also, that's a great point, because there's literally paralysis right now in Germany. They don't have leadership because they're facing down an election at a time when they're trying to go tit for tat with the President of the United States, who's slapping tariffs on their economy.
They're not in a position to respond. The euro at the moment, 103.18. just about positive. It's pretty much unchanged on the session. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of tariffs, President Donald Trump has ordered a 25% tariff on steel and aluminum imports. The tariffs will go into effect on March 12th and will also include finished metal products. Speaking from the Oval Office, Trump insisted the move helps boost domestic production and bring jobs to the U.S. Meta has begun notifying staff of job cuts, cutting 5% of its workforce, terminating thousands of low performers. The job cuts are expected to affect around 3,600 people, all part of Meta's efficiency push, and will create headcount for hiring new AI talent. Elsewhere in tech, Elon Musk's net worth dipped below $400 billion, as Tesla shares plummeted 27% from their December record. His political reinvention was a key driver for Tesla stock post-election, but they've taken a hit after dismal monthly sales. Musk's Tesla stake still makes up the largest portion of his net worth. And that's your brief. John.
Hey, Danny, thanks for this morning. Appreciate it. We're counting you down to Chairman Powell on Capitol Hill in front of the Senate Banking Committee. That's happening in just about an hour from now. Up next on the program, we'll set you up for the day ahead. From New York City, this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
The Cleveland Fed president with some things to say, Beth Hammack. You'll know that name, of course, from the end of last year when she dissented against the decision to cut interest rates in December by 25 basis points, making a case to stay on hold for, quote, some time, going on to say, as long as the labor market remains healthy, I'm looking for a broad-based evidence that inflation is sustainably returning to 2% before adjusting policy further. Imagine if we heard that from Chairman Powell later this morning.
That might cause a bit of a ripple in markets. She went on to actually give some scenario analysis where she said that lingering upside risks to inflation come from that strength of the consumer, going back to Coca-Cola and what we saw there. How much is this just bolstering the hawkish view, which is that they don't need to cut maybe for the rest of this year?
Chairman Powell, the one to watch a little bit later this morning. In about an hour from now, you'll hear from the Fed chair, kicking off his two-day congressional testimony. Tomorrow, the next stop for us is CPI, tomorrow morning at 8:30 Eastern Time. Thursday, PPI, and another round of jobless claims. On Friday, U.S. retail sales, plus the Munich Security Conference kicks off as well. Expect plenty of headlines from that. The Vice President, J.D. Vance, set to attend. Joining us from the nation's capital in Washington is Bloomberg's Tyler Kendall. Tyler, we've had a conversation with you all morning about the prospect of additional tariffs and whether some countries, some companies can secure a carve-out. Have we found one nation that might be in luck?
Well, John, we might have the White House confirming this morning that President Trump did hold a call with his Australian counterpart. In a readout, the White House said that the pair discussed this idea of expanding defense industrial capacity, also addressing what they called, quote, mutually beneficial trade, as well as concerns about competing with China. That's important, considering that we know that a senior administration official told reporters last night that part of these steel tariffs went into place in a bid to curb what they called alleged efforts by China to circumvent some tariffs. But it remains to be seen whether or not this will officially go into place as an exemption for Australia. But at the end of the day, President Trump has said that this all comes down to trade deficits, which is why Australia might be in luck here. We know that President Trump is looking to revitalize what he says is this domestic manufacturing base. But it does remain to be seen if that could go against some of his other campaign priorities, particularly as we watch for any inflation.
A little bit later, Tyler Kendall there of Bloomberg. In the nation's capital, some countries will be able to negotiate this away. Other countries, some continents, might struggle.
Yeah, so if they have a trade deficit with the United States, if the U.S. has a surplus with them, like Australia, potentially they have a very good bargaining hand when it comes to maybe negotiating this away. For others, namely the European Union, which Trump said last week they've been a, quote, atrocity, it's not going to be negotiated away easily. And actually, I think it's just going to get worse when he talks about reciprocal tariffs.
Which is the reason why I actually think it will be interesting to see how Fed Chair Jay Powell responds to how this weighs on his view of policy. You were talking about the Cleveland Fed president, Beth Hammack. She talked about tariffs, and she said it is appropriate in light of tariffs to be patient with policy. Given the recent history with elevated inflation, the risks to the inflation outlook appear skewed to the upside. This is not a neutral stance. This is one that does not speak to any accommodation or easing anytime soon.
I think we found one, didn't we? One of those officials that incorporated tariffs into their outlook.
I mean,
I think we might have found one.
Maybe this wasn't back in December, but you know. Possibly.
Coming up tomorrow, Lisa Shallard of Morgan Stanley, Congressman French Hill of Arkansas. We'll catch up with Anastasia Amoroso of iCapital and Mohammed Al-Erin of Queen's College, Cambridge. A stacked program as we count you down to CPI tomorrow morning. From New York City, this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people in the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out, which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
All right, it's Humphrey Hawkins. So anything can happen today. Right now, we're looking at futures down with 30 minutes to go until the start of cash trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, Powell heads to Capitol Hill. The Fed chair faces tough questions as Trump policies spur caution.
Sam Altman says OpenAI is not for sale and blasts Elon Musk's tactics in a Bloomberg scoop.
Meanwhile, Meta's rally makes history as Mark Zuckerberg's AI bet starts to pay off. Stock still looks relatively cheap, though. All that and more coming up. But let's take a look at where markets are trading. Like Matt said, 30 minutes until the bell. You can see we're taking a bit of a breather today. We had a big start to the week yesterday. The S&P 500 right now in futures trading currently off by about 0.5%. Big tech even more. Of course, we're coming off of 2 straight weeks of losses, and you can see some of that weakness coming in the pre-market right now. The NASDAQ 100 down about 0.8% if you round there. And the bond market, keep an eye on that one. Of course, the 10-year Treasury yield currently higher by about 3 basis points. We are back above 4.5%, Matt Miller.
Back into the danger zone. Okay, as we get closer to the Senate grilling of Chair Powell, let's take a look at how the Fed is set up in terms of risks to inflation or risks to jobs. Here we have in blue the number of Fed officials who are worried about inflation risks to the upside. Now 15. That's the highest level since 2022. In yellow, you see the concern about the jobless situation, and that has come down as unemployment dropped to 4% even.
You've got the macro, I've got the micro. It is still the season that never ends. It is earnings season, and we have some stocks we're watching because of it. Shopify is now up about 2.3% pre-market. It has been fluctuating. It plunged as much as 9% this morning, despite a revenue beat last quarter and an outlook that's mostly in line with expectations. Now higher, though. Coca-Cola up about 4.3% pre-market. It topped estimates as global demand for beverages rises. Consumers are willing to pay higher prices for drinks, with sales growing 6% last quarter. We're going to talk a lot about the consumer. Supermicro now down almost 5% pre-market. They're going to release an update on its business today. It struggled with AI demand following accounting issues last year, but some investors are still optimistic. Its stock is up some 60% in the past week, Matt.
Yeah, the question is, do they get to stay in the NASDAQ, right? If your accountant says, we can't verify this accounting anymore, we quit, that's usually a bad sign.
Yeah, but, they found a new one. I'm looking forward to that business update. We have a lot of testimony to get through before then, though. I'm pretty interested. I know that, you're back and forth on whether you care about the Fed.
I always care. The question is, to what degree is it really driving the trade?
What I'm interested in, of course, there's the politics of it all, but there's also a lot of subjects that Powell doesn't like to talk about. I'm talking about fiscal policy, of course. He can't make monetary policy in a vacuum, and we know he's going to be getting some questions when it comes to tariffs, immigration, et cetera, what that means for inflation, what that means for growth.
It'll be quite frustrating. And of course, you have a lot of lawmakers that feel very frustrated, not about that short end of the curve, but the long end of the curve that perhaps are more linked to mortgage rates. People in their districts can't buy homes. And so you have a lot of things that are kind of outside of his control. So a frustrating 24 hours that will lead us, of course, into the CPI data tomorrow, which is another big moment for this market. Debatably, I know, but people are already trading around it, buying straddles in case of any moves in the S&P 500.
Right, I never say the Fed doesn't matter. I just say it matters less at times and more at others. Let's bring in Marianne Bartels. Sorry, let's get to Mike McKee first for a preview of Powell's testimony. I almost skipped over you, Mike, because I'm looking at Marianne over here on set. We'll get to her in her winter white, but first off, what are we waiting for this afternoon?
Well, we've already gotten a comment from a Fed official this morning, Beth Hammock from the Cleveland Fed. She's in your blue group, Matt. Worried about inflation, saying the risks are to the upside and that monetary policy should stay on hold for a significant period of time. Now, do not expect Jay Powell to take that kind of a firm stance on policy. He's going to have two audiences today, one Wall Street, one the banking committee members in the room. As for Wall Street, he doesn't want to be firm in what he's going to do because he doesn't want the markets to move much since he doesn't know which way he's going to want them to move. But he does have a problem that reflects what Hammock's comments said today, and that is that the dollar, a little lower today, but has been strengthening, and any thought that rates are going to stay higher for longer will push it up and have a negative effect on corporate profits and also reduce the impact of any tariffs. Also, inflation expectations rising. We saw that with the University of Michigan, and if you look at break-evens on Wall Street, they have been rising since Trump took office, and that's something the Fed is going to have to keep an eye on. But also, he does have the banking committee. He's going to have to talk about things, as you mentioned, he doesn't like to talk about. One will be DEI. The Fed is an independent agency, but has taken down its DEI website. Whether the officials will press him to do more or less, we'll have to wait and see. But remember, their whole monetary policy strategy was based on letting the economy run hot to help lower income people get jobs. He'll also probably be talking about bank regulation. There'll be a lot of questions about that and what's going to happen now that Michael Barr has resigned and we have a new administration in place that wants less regulation. And also, he's going to probably be asked about where they go from here in terms of their review of policy. Do they keep that run it hot philosophy going forward?
All right, Mike, we're going to check back in with you in just about 55 minutes from now, ahead of the testimony to get us set up for that on Capitol Hill. Let's bring in Marianne Bartels, Sanctuary Wealth Chief Investment Strategist. And, we always sort of have this debate. I know, obviously, whatever Powell says can move the 2-year dramatically in the moment. But how much does it matter right now to the market since we know, essentially, that the Fed is on hold?
I think CPI is going to be more important than Powell's testimony, the actual real data. The markets are worried about tariffs because we talk about them every day, right? And then Trump is doing something with tariffs, it feels like almost every day. But I went back and looked at his last administration, and when he left office, CPI was 1.4%. The tariffs that he did implement during his last administration didn't result in the long term with inflation. So although I think the markets will be concerned and investors will be concerned about inflation, I'm not concerned about inflation. I'm not seeing it priced in the market. In fact, technically, as I look at the 10-year, it's formed a head and shoulders pattern and broke down. So there's a good chance if we get good inflation data this week that we can actually see the back end of the curve actually drift down. And on the opposite end, it's possible I'm getting bullish technicals on the equity market. When was the last time we had the equity market going up and the bond market going up? And I think if that happened, that would be what's unexpected in the marketplace this week.
Interesting. So how do you invest around that sort of nonchalance you have when it comes to inflation? You're not seeing it in the market. It seems like the technicals are lining up as well. I mean, is that a blanket buy at the index level, or are there specific parts of this market that you would target here?
So I'm pretty bullish this year. I still think the markets can be up 20% this year. Going back
20%.
20%.
So like 7,200.
Correct. So my range is 7,200 to 7,400. The last time we had 3 years of a market that was able to grow 20% or more was back in the 90s. So I equate all of this AI, robotics, blockchain, crypto, this huge innovation bucket being bigger than what we even saw in the 1990s. And I think based on earnings, based on technicals, we can have the market going up despite the market having a very high valuation. I wouldn't be surprised if valuations are able to continue to expand. But to get to your point, what do I like? What's most important to this market is leadership, and technology is the leadership. If technology can come back, and it's been churning, and I just got a buy signal, short-term buy signal, that leadership should drive the rally.
How necessary is that? Because something I was looking at this morning was the S&P 500 relative to the NASDAQ, relative to the Russell 2000, as we've been watching for the last year, it feels like now, and what it looked like compared to the S&P equal weight. Because in January, you did see the equal weight really come back in a significant way. You have seen some of that gap really narrow because of that tech leadership. Do you think that that broadening trade still exists, or is it kind of just big tech going to be driving this market through the end of this year?
I think broadening out, it has happened and can continue to happen. But I believe in a secular bull market. For that to be intact, your leadership has to be intact. So if we lost tech, you lose the market. That's my philosophy. So I actually still believe in tech. And, you know, if I look at the technicals, the one index we don't talk about anymore that I think is more significant, and I know the name isn't as sexy as Mag 7, is the FANG index.
Oh, my goodness.
Because it's a little bit broader.
I thought you were going to say the Dow.
No. FANG, because I get more of tech and tech related. And there's nothing broken in that index. It's churning. I think you're getting a rotation within tech. But I think it's setting up to actually take back leadership within the marketplace. But that doesn't mean other pockets can't come along. I do like financials. I like the banks. I like the capital markets, especially if we can get M&A and IPOs. There's pockets of industrials that I like for the build out for infrastructure. So a broadening out can happen, but I think the leadership stays tech and tech related.
You know what the F used to stand for?
Facebook.
Facebook. Now it's Meta, and Meta has been on an absolute tear, up 16 straight days.
Was the N for Netflix, though?
Yeah.
And not for NVIDIA, right?
No.
Correct.
So what do you think about NVIDIA?
So NVIDIA,
I mean, does DeepSeek undermine, does the idea that DeepSeek was able to create a ChatGPT comparable product at a huge discount, does that undermine the valuation of NVIDIA?
well, I think it's still questionable if it was really at a significant discount. But what I think that what the DeepSeek really shows is how fast technology is evolving. And that's a good thing. But semiconductors, I've liked semiconductors for a long time, and that was my top sector last year in 2024. But you get important rotations in technology, and the market is shifting to software. I think the big moves we've had in semis need to consolidate. So NVIDIA, although it's a company that I like longer term, wouldn't be my top pick for 2025. I think going into the software space will outperform semis in 2025.
I'm looking at, it takes me sometimes a while for something to dawn on me.
Right, right.
I'm looking at Meta, and you point out it's been doing well.
Yeah.
Is it up every day for the last
16 days. That is the longest streak of any component of the NASDAQ 100 in data going back to 1990.
It's also a big reason that the Mag 7 has still been able to become a leader in this market. A lot of those other parts of the Mag 7 have, you know, wavered.
Yeah, it's undeniable, of course, Meta really having a fantastic start to 2025. Marianne, it's always great to see you. Hope to see you again in person soon. That is Marianne Bartels of Sanctuary Wealth. Meanwhile, speaking of tech, let's check in on Apple and Alibaba, because both stocks moving higher right now in the pre-market after a report that they are developing AI features for iPhone users in China. You can see on the other sides, Baidu falling on that news, down about 4% right now, Sonali.
Yeah, and coming up next, we're going to stick with AI. We're going to talk about the exclusive we have with Sam Altman, who says that Elon Musk is trying to slow down OpenAI. He discusses his relationship with Musk in an interview. We're going to bring you some of that next. This is Bloomberg.
Probably his whole life is from a position of insecurity. I feel for the guy.
You feel for him?
I do, actually. I don't think he's like a happy person. I do feel for him.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Let's get now to high interest, look at what's making headlines around the world, starting with the trade tensions between the U.S. and Europe. President Donald Trump ordered 25% tariff on steel and aluminum imports. Those levies will hit some of America's closest allies, and the president warned that the rate may go higher. The European Union is promising to retaliate. Commissioner von der Leyen says unjustified tariffs on the EU will not go unanswered. They will trigger firm and proportionate countermeasures. But don't forget, this isn't supposed to go into effect until like 3 or 4 weeks from now. So there's a lot of time to call it off. Elliott Investment Management has built a stake of around $2.5 billion in Phillips 66. Bloomberg sources say the activist investor plans to push the oil refiner to sell or spin off its midstream business. Elliott first disclosed a stake in 2023 and has since named a new board member and sold assets. It's part of a cost-cutting initiative. And it may have started as a side hustle, but in less than 2 years, Chinese AI startup DeepSeek could turn its founder into one of the world's richest people. The company is worth anywhere from about $1 billion to $150 billion. That's a massive gap, but that's according to 7 AI experts and startup founders who spoke to Bloomberg. So varying opinions as to how much it's worth.
Varying opinions and more billionaires to talk about here and more titans of the world of artificial intelligence. Sam Altman says that OpenAI is not for sale after a group of investors led by Elon Musk offered to buy the nonprofit that controls OpenAI for $97 billion. Musk's xAI is a direct competitor, and he has repeatedly taken legal action against OpenAI's practices and mission. Altman sat down with Bloomberg to discuss his relationship with Musk and his plans for OpenAI.
Look, OpenAI is not for sale. The OpenAI mission is not for sale. Elon tries all sorts of things for a long time. This is this week's episode.
You take it seriously at all? What do you think he's trying to drive at with this?
I think he's probably just trying to slow us down. He obviously is a competitor. He's working hard and he's raised a lot of money for xAI, and they're trying to compete with us from a technological perspective, from getting the product into the market. And I wish he would just compete by building a better product, but I think there's been a lot of tactics, many lawsuits, all sorts of other crazy stuff. Now this, and we'll try to just put our head down and keep working.
Does it make it more difficult to move from that non-profit model to that for-profit model for OpenAI?
We're not moving to a for-profit model. We're not sure we're going to do it all, but no matter what, the nonprofit will continue to be extremely important. It will drive the mission. It will continue to exist. The board is looking at lots of options about how to best structure for this next phase, but the nonprofit is not changing it anything or going anywhere. I mean, whether they did or didn't, they built a good model. Many people will distill from many other models. Again, I feel so confident about our research roadmap and also our product roadmap that, DeepSeek will do whatever DeepSeek's going to do. Other people do whatever they're going to do. And we're just going to try to, build the best technology we can and get it into people's hands. And I think that's mostly going pretty well.
Do you think Musk's approach, then, is from a position of insecurity about xAI?
Probably his whole life is from a position of insecurity. I feel for the guy.
You feel for him?
I do, actually. I don't think he's a happy person. I do feel for him.
Okay. Do you worry that he has this proximity to the president and he can influence the decision-making of the U.S. presidency and policies around this agenda on AI?
Not particularly. Maybe I should, but not particularly. I mean, I try to just wake up and think about how we're going to make our technology better.
Bloomberg's Tom McKenzie conducted that interview from the Paris AI Action Summit, and he joins us now. Tom, great reporting, man of the hour over there in Paris. So a hostile bid for OpenAI, you could call it, but Sam Altman obviously coming out with some hostile words of his own for Elon Musk.
Yeah, look, it's getting personal now. This history, of course, goes back to 2015 when the two co-founded OpenAI and, of course, famously have fallen apart as a result of what Elon Musk says is Sam Altman's push and drive away from some of the founding principles around open source models, around safety-focused models, and around non-profit. That is the allegation, of course, of Elon Musk, and Sam Altman pushes back very strongly on that, talking about the fact that this is a man he thinks now, Musk, is someone who is insecure, is unhappy in his life. It has taken a personal twist, and it is the latest gear shift, of course, in terms of Elon Musk trying to pressure Sam Altman. It's also a reminder that there is an arms race right now at a startup level in terms of who gets to control this revolutionary technology, if that's what you believe it's going to be. Who gets to control it at a startup level? And it's part of the conversation in Paris as well on a sovereign level as well. Nation states trying to ensure that they're not left behind in this race. And to some extent, this feud between Musk and Sam Altman distills that tension.
Well, I think important as well is who else might be behind the bid, how seriously to take it with the valuation that's been proposed, as well as the other potential investors, Barron Capital, Joe Lonsdale's VC firm, Ari Emanuel. Is the bid real?
Yeah, look, I mean, speaking to executives on the ground in Paris, off camera, I saw some eye rolls, some heads and hands when I asked them about this. A lot of them are not taking it seriously. Sam Altman says he's not taking it that seriously. He thinks it's just the latest chapter. But don't you have to take it somewhat seriously, coming from the world's wealthiest man, coming from someone with proximity, as he does, to President Trump? But you're right, the valuation gap is there, right? 97 billion versus 157 billion versus 157 billion back in October. About 300 billion is potentially the valuation right now as they try to fundraise maybe a 25% stake from SoftBank, above the 13% stake from Microsoft. The valuation gap is a mismatch. Yeah. Is he just, as you suggested, just trolling Sam Altman at this point?
100%.
Sam puts it in this perspective. It's a gear shift.
I mean, just because Elon Musk is the wealthiest man in the world doesn't mean he's beyond, seriously dank memes. He can troll with the
You
best of
think
them.
those memes are
Yes.
seriously dank?
Remember when everyone thought buying Twitter, now X, was a joke also?
Yes, and remember when he tried to get back out of that?
I'm still not
Remember
convinced
when he
that
raised all that money in
it
debt
wasn't a
markets that
joke
they're just
that
paying back?
He ended up having to follow through on. Tom, great reporting. Really appreciate you taking the time. That is Bloomberg's Tom McKenzie joining us from Paris. Of course, a great interview with Sam Altman from Tom earlier today. Let's take a look at futures right now because we're still lower in the pre-market. Just minutes ago until the bells rang, the S&P 500 down about 0.4%, even more if you take a look at big tech, and even more if you take a look at the small caps. We'll take a look at the action and walk through it in more detail next. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
All right, welcome back to Open Interest. You're taking a look at futures right now in the red ahead of the opening bell. The S&P 500 is down about 0.4%, and then it gets worse from there. I want to talk about Meta, though, because Meta also down pre-market, which is a shame because it just closed out 16 straight days of gains. That is the longest streak for a NASDAQ 100 component in data going back to 1990. And what's interesting is that if you take a look at the valuation, it trades at about 27 times forward earnings, which is lofty, to be sure, but that's pretty much in line with the NASDAQ 100, so it's not off the charts expensive.
I think people are worried that we may get a breaking headline that Elon Musk is offering $247 to buy Meta.
You know,
with a group, with
that
Ron Barron and a couple of other...
It's a bit of vindication, isn't it, the conversation over the last couple of weeks around open source. This is what Mark Zuckerberg has really been pitching from the beginning when it comes. But coming up next for less than 4 minutes from the opening bell, we're going to discuss those market moves with David Kostin of Goldman Sachs. Stick with us. This is Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are down here. 0.4% for the S&P 500, a little bit more for the NASDAQ, 0.2%. And this is even more disappointing because it means Meta may close down after 16 consecutive days of gains. Longest streak going back to, what did you say, Katie?
1990s.
1990s. So
fudge it a little bit.
Pretty cool stat there. You see SNL, Saturday Night Live, ringing the bell down at the New York Stock Exchange. Some say it's a set, so it's, I think, appropriate. And then you see Global Star ringing the bell, GSAT down at the NASDAQ. In terms of the major averages, which have now been trading for 24 seconds, Katie, what do we see?
Well, now it's 27 seconds, and similar to the pre-market, you can see we're lower on the day, but it's very early. The S&P 500 off by about 0.3%. Of course, we had a big day yesterday. Then you take a look at big tech, also lower, like you mentioned, Meta coming under some pressure after that big run-up that we saw. The Nasdaq 100 off about 0.5%. And then even worse, if you take a look at the Russell 2000, currently off by about 0.7%. We are seeing bond yields climb once again, maybe putting some pressure on those small caps. But let's take a look under the hood, and let's actually go to Canada, because Shopify revenue increased 31% last quarter. Also expects an increase in the mid-20% range for the current quarter. It was down as much as 9% pre-market due to free cash flow concerns. Shaking that off right now, Sonali, currently up about 1.8%.
Yeah, the consumer is in full swing today. I'm keeping an eye on Coca-Cola here as well. They reported a rise in global demand as higher prices led to higher profits last quarter. Coca-Cola has been largely unscathed, even as budget-conscious shoppers pull back on spending. You have the stock up more than 4.4% as the market opens. Interesting after McDonald's. Also, some strong consumer names reporting this week, Matt.
Yeah, we talked about that yesterday. I think someone had brought fries into the studio, which was distracting me for the whole program.
At 9 in the morning?
Coca-Cola, by the way, has drastically underperformed the food and beverage ETF and the consumer discretion. Yeah. Is it a discretionary Coca-Cola?
I think so. I mean,
or is it a staple?
Some would quibble on that point, but we'll have to check
Only
the
up
official.
8% in the past 12 months.
It's not very much.
And the
relative to
S&P, the broader market, is up 21%.
You know what's been up a lot recently?
Meta.
Yeah.
16 sessions, as you said. That's a pretty amazing stat.
Yes, yeah, that is quite an impressive streak. But as we're talking about the valuations, not too expensive. People keep telling us that it's a stock picker's market. It seems like this time they really mean it. You have to wonder how many people.
It's true. It's a $2 trillion company now, but lowball bids are en vogue.
It's kind of plateauing now, not to kind of parse hairs about it, but it's interesting that you did see still continually it rising after that big CapEx spend. I think they set the tone for everybody else, DeepSeek
I think we
or not.
split hairs.
Split hairs.
We parse words.
You know, I never know my idioms. It's such a problem. That's going to my family today, I know.
I don't split hairs, obviously.
Anyways.
Let's bring in David Costin from Goldman Sachs. He's the chief U.S. equity strategist there. And David, you know, we're talking about these consumer stocks doing well with earnings. They're able to raise prices. This is what I think is going to be fascinating when we get CPI tomorrow. How many have raised prices to start the year? But what's your take on earnings season thus far, and what do you expect for 2025? Because as I look at earnings expectations, we were so bulled up at the end of last year. I think the consensus on the street was like 14%. Now it's steadily come down. You were at 9 at one point. It's steadily come down to less than 11, and you've moved up to that level.
Well, we're pretty much most of the way through the reporting season for the quarter. And the report card is as follows. We have year-over-year growth of around 12%. So let's put that in perspective. Coming into the quarter, Matt, the expectation was year-over-year growth of around 8%. So 400 basis points, 4 percentage points of positive surprises. That matched the average for the last 12 quarters. So we've seen a pretty consistent set of beats. And if you want to think about that skew towards the larger companies, while 12% was the aggregate index year-over-year growth, the typical stock was reflecting year-over-year growth of around 7%. So again, you saw the impact for the overall index from the largest cap, some of the mega cap companies, which I'll mention in just a moment. But to your point you just mentioned a moment ago about the margins, well, margins improved by around 50 basis points for the overall index, and that's again pretty good. So you had about 5% sales growth, some margin improvement skewed towards the larger cap stocks, the communication services and the technology sectors really driving the best results in the quarter, energy and industrials at the other extreme. That's pretty much summarizes thus far the reporting season.
Well, let's talk about the elephant in the room, and that, of course, is tariffs. When you're trying to model out what you expect for this earnings season and, of course, the full year earnings season, how do you have any real degree of conviction when there's this overhang, this question mark of what the tariff picture will actually look like?
It's an excellent point. So our baseline forecast, which is a model that focuses on revenue growth and margins at the individual sector level, leads us to a forecast of year-over-year growth of around 11%. That's 11% this year, 2025, relative to last year. And then looking into 2026, we're looking at earnings growth of another 7%. So 11% followed by 7%. That's a baseline. If we want to think about what are some of the scenarios, and obviously there's a series of changing news flow every day, but an increase in tariffs of around 5 percentage points for the average tariff rate across the country, which is currently roughly 3% or so, another 5 percentage points, would reduce our estimates by around 1 to 2%. So therefore, instead of 11% earnings growth this year, it would be closer to 10%, probably trim 1 to 2 percentage points of growth off of our forecast. Again, it's a fluid number, a lot of variables, a lot of moving parts, and that's a big area of discussion with clients. Not so clear exactly how companies are going to respond. They may push back and try to get the suppliers to perhaps adjust their prices to absorb part of that. Some of that's a negotiation. In some cases, they may try to absorb that themselves. In some cases, they may try to push that through to the consumer.
You know, speaking of the consumer as well and potential price shocks that companies might feel, in addition to tariffs, the concerns around immigration policy and what that might mean for the labor market. How are you factoring that into potential future EPS growth and ripple effects here for the consumer that has been showing up quite strong until right now?
So my colleagues in U.S. economics research have published a lot of reports looking at exploring some of the impact of the immigration in terms of the impact on the size of the workforce. From a fundamental perspective, as we think about the drivers of economic activity, it may trim slightly. GDP growth would have a potential modest impact on our overall earnings for the S&P 500 companies, but it's not likely, in our view, to have a significant impact on corporate profits in the coming year.
Yeah, I would think. I mean, in his first term, Trump deported 1 million people. So that's far less than Obama did. But if he follows through on those threats to deport a large portion of the workforce, I would think, David, that drives up costs. You know, labor costs, if you don't have anybody to rebuild the homes in LA, if you don't have anybody to, do the jobs that some of these millions of immigrants are doing now, and there's no new labor coming in, don't you see, is that just a longer term problem, or?
Well, there's if we'll think about it analytically, the labor budget for a typical company is around 14% of its sales. So Matt, that looks at salary, compensation, bonuses, healthcare benefits, which is, in America are paid through via the employer. So that wage bill, aggregate, is about 14% of the sales for the typical S&P 500 company. And that's going to give a range from maybe 5% at the low end to maybe 30% at the high end. So that would be a very high labor-intensive company. And so that's a way of thinking about the impact of and the proportion of labor costs as compared with, say, raw materials. Different industries, of course, have different labor intensivities, and that has both impact from an inflation point of view, but also from an AI point of view, and the artificial intelligence, which industries may be more or less likely to benefit as a result of maybe the efficiencies that might be gained through the point of AI. So it's a huge topic of interest to portfolio managers. We focus on this a lot in our own research and thinking about which companies may or may not be more negatively or positively affected from their margin point of view specifically.
All right, David, unfortunately, we have to leave it there. Great to get some time with you. That is David Kostin of Goldman Sachs. Now,
and I learned something.
You did?
Yeah, I mean, that is fascinating. 14% on average is labor costs.
Yeah.
And obviously, if those prices are driven up by one thing, deportations, they could be also driven down by AI.
A lot of investors banking on that productivity initiative. Let's see if it comes through fast enough to offset any potential price hikes.
All right, coming up, hedge funds are eating into clients' gains with no limit fees. More from Bloomberg's latest analysis next. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
We want to bring you some breaking news out of Goldman Sachs. The company is killing its IPO diversity pledge as DEI programs come under fire across the country. Joining us now with the latest, Sridhar Natarajan, Bloomberg's chief Wall Street correspondent. You think about when they made this pledge in 2020. The idea was to have one diverse board member. They increased it to 2. It came out with a lot of pomp and circumstance. So what is now the mood, both among Goldman employees and their clients, to now roll this back?
It certainly came with a lot of hype, because remember, when they announced this back in 2020, this was David Solomon high up in the Swiss Alps talking about this policy and professed their unwavering commitment to diversity. This was a time when across corporate America, and especially financial firms, were leaning into this idea that diversity is important and they need to encourage it, and they need to find ways to encourage it. State Street and BlackRock were using their voting power on a bunch of different companies. Goldman, the leading investment bank on Wall Street, came out and said, we will refuse to take a company public unless it has at least one diverse board member. So it effectively was supposed to be the end of the all-white, straight male boards. They even upped the ante and made the requirement 2 for companies that they were taking public in Western Europe and US. Well, today they've formally confirmed that they have backtracked. We've already seen 1 or 2 companies where that policy certainly slipped away. And you have to see what's happening in the broader environment. There's obviously everything that you've seen change since Donald Trump re-entered the White House. There was, of course, the NASDAQ board diversity rule that was killed in the Fifth Circuit as well. All of these things played a fact, and this is Goldman just acknowledging, and this is a nod to the time that we're in.
Yeah, well, I was wondering that. I mean, you have to wonder, you know, is this a direct response to Trump? But then you bring up the NASDAQ point. I mean, that predated the inauguration.
And again, it's not entirely clear that if this was, say, a Democratic administration, if this was a Harris administration, even with that legal precedent, would Goldman Sachs necessarily have killed this initiative? Would other companies have killed their DEI hiring goals? Because this is a board diversity push, but there were other things that people were putting in place, including rank and file, how many people they were hiring, what the makeup of the new hire should be, how many people they were promoting, what their executive class should look like. It's hard to imagine a scenario where you can definitively say that President Donald Trump, once again, did not play a role in this, even if we cite all the legal precedents.
And in the statement to Bloomberg News, Tony Fratto, the spokesman for Goldman Sachs, said legal developments related to board diversity requirements caused them to end the formal policy. So 5 years, come and gone. Sridhar Natarajan, we thank you so very much for your time today. We're going to now move to today's big take story, hedge funds. We're going to move to the hedge fund industry because they have been eating up client gains with their pass-through fees. A Bloomberg analysis of regulatory filings spanning over a decade details costs ranging from copy paper to private jet flights. Hema Parmar co-wrote the story, joins us now. Hema, this is really indicative of a massive trend this year where you're seeing, yes, certain funds do very, very well, but that talent war get more and more heated in the hedge fund industry, meaning that these pass-through fees, despite how much certain investors might hate them, have been status quo, haven't they?
Yeah, you know, pass-through fees are the most coveted perk of running a multi-strategy fund. You get the investors to pay for pretty much all the costs of running the firm. And so what we're seeing is that, you know, our analysis of the disclosures shows that the number of fees disclosed has increased by 40% over the past 5 or 6 years. And, you know, we really see how the costs of these pass-through fees can eat into returns when a fund doesn't do so well. So if we look at the Balyasny example, that fund produced a gross return of 15%, but because the costs of the pass-through fees, most notably compensation, were so high, it ate into returns such that investors only walked away with less than 3% in gains.
I was actually going to ask, you know, what's the biggest expense?
Yes.
I thought maybe it would be private jets. I understand that they're a necessity because I just flew commercial to Indonesia and back, and it shouldn't be allowed. But I guess compensation is going to be the big one?
Compensation is the chunkiest by far. If we look at Balyasny, they spent over $600 million of their more than $700 million in pass-through fees on compensation. We see hundreds of millions of dollars in compensation fees. And that's because you're looking at an environment where there's a fever-pitch talent war. You're seeing pay packages for some of these traders reach the $50 million range, $30 million range. And the firms would say that that's because you really need to get the best talent to build these gigantic shops, but they can really weigh. And so it depends on how a fund is doing. If a fund's net return is great, then maybe investors don't mind paying those fees. But if the performance is mediocre or poor, then they might think twice.
Emma, don't mind paying those fees. You know, Matt asks a lot why investors are investing in hedge funds if they're trailing the S&P 500, even though that's not the benchmark. It's an asset management, it's a portfolio management question. You're paying for diversification, perhaps. But if even then the fees are getting eaten up, or eating up the returns rather, are you starting to see investors complaining about the all-in return that they do get back to them?
Some investors do complain. It really depends on the fund that they're in, and it depends on the return that they expect and what they see. So the general expectation is that a multi-strategy fund produces about 1% a month, 12%-ish a year. And so, and the hope is that they don't lose your money. So some of these firms have never lost money or only lost it once in their 20-year history. And that's what you're betting on, the reliability, the consistency, and investments that are not correlated to the market.
When we, by the way, when we show these performance figures, Hema, are they net of those fees?
That's a net return, yes. But when a fund is mediocre, if you're producing less than that 12% threshold, if you have multiple consistent years of not meeting investor expectations, then those costs, you're looking at them again. And you're wondering, okay, well, what am I paying for?
Yeah, especially when actively managed ETFs could be only charging 7 basis points.
That's true.
Emma, thank you very much. Emma Parmar there talking to us about hedge funds. I know different benchmarks, completely different. Apples and oranges, I get it.
No, but that's a lot of fees
Still.
to just not be handed back in terms of returns. So
when we come back, we're going to focus in on Humphrey Hawkins. That's what we used to call these semi-annual.
I love these testimonies. I'll be honest with you.
Yeah, Fed Chair Powell is at Capitol Hill. Day one, this is Senate day of his monetary policy testimony. We'll take a look at what the market is anticipating next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
All right, we're just about 10 minutes away from Powell's Senate testimony. He also testifies tomorrow in the House. We also get CPI, PPI, jobless claims, and retail sales data in the span of just 3 days. Let's preview it all now with Stuart Paul of Bloomberg Economics. Great to see you, Stuart. So we'll start with what's happening in 10 minutes, of course, the Senate testimony. And it seems like reading the sell-side research ahead of the testimony, Powell will want to try to not make news here, but what do you think some of the hottest topics of discussion will be?
There are some items that are especially predictable. We know that Senate Democrats are going to come out, probably Elizabeth Warren, starting with a question, why did the Federal Reserve withdraw from an agreement to green the financial system? She'll probably press Chairman Powell on how secure the CFPB's funding is, because again, they don't get it through congressional appropriations. They get their funding from the Fed. We could expect Senate Democrats to push.
Wait, haven't they requested $0 in funding?
So
that would seem to be very secure.
We know that Russ Vought, former OMB director, is now temporarily running the CFPB, but because again, it's sort of a peculiar appropriations process, we'll see what happens there. Maybe more market relevant is just how forcefully Senate Democrats are going to be pushing for additional rate cuts this year, and also probably more market relevant is whether Senate Republicans will get aggressive in asking Chairman Powell about the effect of the national debt, fiscal sustainability, and so on.
You have to understand the CFPB issue. I know that it's something that's been kind of amorphous and a lot of pushback already, but it's something where bankers across the street are breathing a massive sigh of relief too, because this is potentially billions of dollars in overdraft fees and credit card fees that might stay on the table now that might have otherwise been challenged.
Bankers breathing a sigh of relief. I don't know about the consumers.
By the way,
right, exactly.
Otherwise, what, you're allowed to overdraft, so you essentially borrow money from the bank for free?
These have been super challenged over the last several years. There's a lot of debate about whether they should exist or not, but it is interesting because of the Fed oversight of this too. A lot of people believe that there's a duplication of the issue here too. But anyways, beyond the CFPB, which of course is a huge issue, you know, how are they going to just handle the issue of inflation, right? This is before the CPI data comes out, which makes some of the challenge here a little difficult because there's so much you can't say.
It is, that's right. You have to wonder. We heard earlier this morning from Beth Hammack, Cleveland Fed president, who came out saying that inflation risk is skewed to the upside. You have to wonder the extent to which she's coming out ahead of Chairman Powell and his testimony, provide a little bit of breathing room so that he can say something, maybe not the same, but similar. Maybe that, for example, the Fed is well positioned to respond to upside and downside inflation risks. I think that Chairman Powell is going to attempt to rebuff requests from the Democratic members of the Senate who are pushing for swifter rate cuts, and instead say that the Fed needs to remain rather nimble and keep its options open, especially given all of the policy uncertainty that's coming out of the executive branch.
How does the labor side look to you now that we've had a few days to examine the non-farm payrolls number? I saw Torsten Slok sent out, you know, an alert that someone said the weather really did hold the number down. You know, the averages were good. How does it look?
Yeah, so undoubtedly the January numbers were affected by the polar vortex in the lower 48 states. There was also very minor effects from wildfires in Los Angeles. But beyond that, separate from what I think that Chairman Powell is going to be very clear in saying that the labor market is currently solid, but wage pressures emanating from the labor market are starting to dissipate. We do see that a little bit when we look at job openings data relative to total unemployment, where the total relationship between supply and demand for labor is starting to come into better balance.
All right, Stuart, got to leave it there. Great preview. That is Stuart Paul of Bloomberg Economics. A much more markets coverage coming up ahead of that testimony. This is Bloomberg.
Do you mind if you step up?
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg. Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Peter King. President Trump hosts Jordan's King Abdullah II at the White House in about an hour and a half. Here's CBS's Stacey Lynn.
The two leaders will surely discuss President Trump's plan for the U.S. takeover of Gaza, which includes Jordan and Egypt taking in Palestinian refugees. Both countries have flatly rejected the proposal, and yesterday President Trump suggested he could consider slashing U.S. aid if they refuse. He also issued an ultimatum to Hamas, insisting they release all the hostages by noon Saturday, or
all bets are off and let hell break out.
Trump hasn't spelled out exactly what that means. Hamas says it's delaying its next hostage release because Israel violated the ceasefire agreement. The president says his tariffs on imported steel and aluminum could be the catalyst for new U.S. businesses. CBS Money Watch correspondent Kelly O'Grady says there's a downside.
Tariffs can mean higher prices for consumers, and I'm really talking about in the home building and automobile industries, both industries that leverage aluminum and steel.
The president's border czar is taking on the Pope, who's criticized the Trump administration's deportation of undocumented immigrants. Tom Homan says he wishes the Pope would fix the Catholic Church and leave border enforcement to the U.S. The Pope isn't the only religious figure speaking out. CBS's Jim Krasula.
Nearly 30 religious groups, Christian and Jewish, representing tens of millions of Americans, have sued the Trump administration to protect houses of worship from immigration arrests. The lawsuit, filed in federal court in Washington, D.C., contends a new Trump policy allowing immigration raids at church services is lowering attendance at worship and other church programs.
Former Trump advisor Steve Bannon is in a New York courtroom. He's expected to plead guilty to fraud to stay out of prison. CBS's Michael Wallace.
Bannon is accused of deceiving the hundreds of thousands of donors who gave over $25 million to the We Build the Wall organization to help build the wall along the U.S.-Mexico border. Bannon was allegedly part of a scheme that funneled money to the group's CEO, Brian Kolfage, who had said he would not take any compensation. Kolfage is serving 51 months in prison.
Stormy weather means rain in the deep south, snow from a storm that stretches from Missouri to the mid-Atlantic. CBS Philadelphia meteorologist Kate Bilo with a few football references thrown in.
It's going to be tracking from Texas right across the Mississippi Valley today, so impacting basically Chiefs fans and then Eagles fans alike. Snow just north of Nashville, portions of Kentucky, and into West Virginia and Northern Virginia. It looks like D.C. may be the big jackpot.
Wall Street and early trading, the Dow is down 85. This is CBS News. Boeing says it'll lay off about 400 employees who've been working on NASA's Artemis moon program at the Kennedy Space Center. Boeing makes the core stage of the Space Launch System rocket that's expected to fly 4 astronauts on a trip around the moon next year. Well, the numbers show that this past Sunday was indeed super.
The Vince Lombardi Trophy is headed to Philadelphia.
Nielsen says the Eagles' win over the Chiefs drew a record average of 126 million viewers. A record 13.6 million streamed the game. And 2 top sports books, BetMGM and Caesars, say Super Bowl 59 was the most bet single sporting event in each of their histories. Caesars said it was the first Super Bowl in which more game parlays were bet than more traditional straight wagers. Philadelphia quarterback Jalen Hurts had the most money bet on him to win Super Bowl MVP, which he did. Steve Kathan, CBS News.
And I'm Peter King, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Norma Linda and John Tucker. Paul Sweeney is off today. This is the moment. It is Jay Powell testifying in a semi-annual testimony to the Senate Banking Committee. We will bring you that Q&A live. Some of prepared remarks are already out. Here are some of the highlights. He reiterates no need to hurry to adjust rates. Also talks about the labor market being broadly in balance and not a source of inflationary pressure. Also, Nora talking about long-term inflation expectations appearing well anchored. Very key because we looked at the UMich 1-year inflation expectation and that really soared quite high.
Right. It showed the opposite. It's interesting. We're really trying to get down to this 2% target and we're not there yet. And of course, we've got additional tariffs on the mind of investors. So many things going on that we're going to have to keep an eye on today.
So I'm pretty sure Jay Powell is going to try to avoid saying the word tariff as much as possible. We will bring that to you. Currently, Chairman Senator Tim Scott is speaking. We'll bring you that testimony, though, live. Let's get you also an update on what's happening in the business world. For that, we go to John Tucker.
All right, and this Bloomberg Business Flash being brought to you by IBKR. Will the percentage of U.S. experiencing drought conditions exceed 18% on February 18th of 2025? At IBKR Forecast Trader, the yes was recently at 35%. What's your take? Trade your prediction at ibkr.com/forecast. Let's just power through this as we wait for Powell. Stocks lower, trade tensions Yields rising. They were higher ahead of Powell's testimony before Congress. The 2-year yield up about 2 basis points, 4.29 right now. The European Union vowing to respond to those 25% tariffs imposed by President Trump on steel and aluminum imports. Coca-Cola among the most actively traded right now, up 3.6%, profit beating Wall Street expectations. Among the best performers, DuPont, those shares, they are rising right now almost 5%, earnings jumping on growth in their electronics market. And Humana, the health insurer, forecasting revenue for this year that exceeded Wall Street expectations. However, the shares in the early going right now down 1.6%. Overall, the S&P 500 down 17 points at 6,048. The Dow Jones Industrial Average 147 points lower. The NASDAQ 100 right now down 60 points. We check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker. Back to you, Nora and Alex.
All right. Thanks so much, John Tucker. So we have Jay Powell's testimony. Obviously, that's going to be key for investors. But man, there is an OpenAI, XAI tit for tat unveiling within the market as well. So what was your take when you heard that yesterday?
Really interesting, right? I mean, lots to keep an eye on, especially with OpenAI. We've been talking about DeepSeek. So many things going on in the market right now, and investors don't know where to look.
So the report, of course, was that Elon Musk, through a consortium of investors and XAI, his AI platform, was making a bid just shy of $100 billion for OpenAI. Now, earlier, Bloomberg's Tom McKenzie was able to sit down with OpenAI's chief executive officer, Sam Altman, at the AI Action Summit in Paris. In a wide-ranging conversation, when he was asked about Elon Musk's bid to buy OpenAI, Altman said the company is not for sale, and he believes that Musk's bid is an attempt to slow them down.
Look, OpenAI is not for sale. The OpenAI mission is not for sale. Elon tries all sorts of things for a long time. This is this week's episode.
You take it seriously at all? What do you think he's trying to drive at with this?
I think he's probably just trying to slow us down. He obviously is a competitor. He's working hard and he's raised a lot of money for XAI, and they're trying to compete with us from a technological perspective, from getting the product into the market. And I wish he would just compete by building a better product, but I think there's been a lot of tactics, many lawsuits, all sorts of other crazy stuff. Now this, and we'll try to just put our head down and keep working.
Does it make it more difficult to move from that non-profit model to that for-profit model for OpenAI?
We're not moving to a for-profit model. We're not sure we're going to do it all, but no matter what, the nonprofit will continue to be extremely important. It will drive the mission. It will continue to exist. The board is looking at lots of options about how to best structure for this next phase, but the nonprofit is not changing in anything or going anywhere. Whether they did or didn't, they built a good model. Many people will distill from many other models. Again, I feel so confident about our research roadmap and also our product roadmap that, DeepSeek will do whatever DeepSeek's going to do. Other people will do whatever they're going to do. And we're just going to try to, build the best technology we can and get it into people's hands. And I think that's mostly going pretty well.
Do you think Musk's approach, then, is from a position of insecurity about XAI?
Probably his whole life is from a position of insecurity. I feel for the guy.
You feel for him?
I do, actually. I don't think he's a happy person. I do feel for him.
Okay. Do you worry that he has this proximity to the president and he can influence the decision-making of the U.S. presidency and policies around this agenda on AI?
Not particularly. Maybe I should, but not particularly. I try to just wake up and think about how we're going to make our technology better.
That was our great interview with Tom McKenzie and Sam Altman over at OpenAI, saying, look, we're definitely not for sale. He did post, though, yesterday. He's like, but hey, we'll buy Twitter for just shy of $10 billion if you want.
They don't like each other, do they?
No. What gave you that idea? Anyway, we're definitely going to keep our eyes peeled for any more updates on that story and bring that to you as they cross. But again, we are drumbeating to the big event, and that is Fed Chair Jay Powell testifying for the Senate Banking Committee. He has his speech already laid out. We are currently watching Senator Elizabeth Warren, the ranking member of the Senate Banking Committee, addressing and welcoming everybody. Then we will take Jay Powell's statement. But in the meantime, we wanted to get more of an update with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. All right, we got the prepared statement. Anything that stood out to you here?
Absolutely nothing. So Powell said exactly what we expected, which was, we don't know what our next move is going to be. And you've heard a string of speakers come out this morning and yesterday, and basically since the meeting, not long ago, that that suggests that the Fed might be on hold for quote unquote some time, right? So, and how do you define some time? Well, historically speaking, some time has meant at least 6 months. So if the Fed's on hold from now until say the third quarter of the year, that gives them some time to assess incoming data, assess what new policies that the current administration is going to be making, and then they can decide whether or not they're going to remain on hold or cut or hike, depending on what the situation is at the time.
So this will be Powell's first testimony before the U.S. Senate Banking Committee since Donald Trump returned to the White House. How do you expect them to push in terms of Trump's proposals on tariffs and a lot of taxation, immigration, regulation? How far do you expect them to push on those questions?
Well, I think members of both the Senate today and then the House of Representatives tomorrow will ask him about it. He won't answer. He's ultimately, Powell's going to say, you know, once we see what the actual policies are and we can assess how they're going to affect the economy, whether it's spending, like maybe he'll go through, here's the things we're going to look at, but he's not going to be able to give an answer to how it's going to affect the policy regime in terms of monetary policy. And that's the right thing to do, because quite frankly, anyone who says that they know what's going to happen because of what Donald Trump's saying, they're making a guess, or at best a guesstimate, right? We don't know what a lot of the policies coming out of Washington are, how they're going to permeate and how permanent they're going to be. You've seen just recently, look, tariffs are on, tariffs are off, tariffs are on, tariffs are off. How can we assess the long-term economy with such uncertainty in what near-term policy is going to be?
But what we can address now is inflation expectations that have been rising, particularly two-year inflation break-evens. We saw in the UMich sentiment survey that one-year inflation expectations shooting up quite unexpectedly, and that he can talk about. And he does talk about needing those inflation expectations to stay anchored. What might he say about that?
Yeah, that's a good point, Alex, because the one thing that we do know is that if there are tariffs, that you know, there will be an increase in the price of goods and services, goods in particular in the U.S., and probably a little bit of more in services too, which has really been driving inflation expectations. So he'll acknowledge that. I mean, he has said in the prepared remarks that the labor market's doesn't seem to be driving inflation. I actually disagree with that statement. If you look at the labor market and how tight it is, and where you're seeing the pockets of price increases, that is being driven by wages, and the fact that you have services prices going up faster than goods prices, and then you have wages in the service sector going up faster than others as well.
All right, Ira, you're getting trumped here by Jay Powell. Thanks a lot. Ira Jersey, Bloomberg Intelligence, Chief U.S. Interest Rate Strategist. Let's go to the Senate Banking Committee, where Jay Powell is just starting his prepared testimony to the Senate Banking Committee.
Both sides of our mandate. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2024, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have declined in the fourth quarter, but was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months. Following earlier increases, the unemployment rate has been steady now since the middle of last year, and at 4% in January remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-term goal. PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Since last September, the FOMC lowered the policy rate by a full percentage point from its peak, after having maintained the target range for the federal funds rate at 5.25% to 5.5% for 14 months. That recalibration of our policy stance was appropriate in light of the progress on inflation and the cooling in the labor market. Meanwhile, we've continued to reduce our securities holdings. With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the FOMC will assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. We are attentive to the risks on both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. This year, we are conducting the second periodic review of our monetary policy strategy, tools, and communications, the framework used to pursue our congressionally mandated assigned goals of maximum employment and stable prices. The focus of this review is on the FOMC's statement on longer-run goals and monetary policy strategy, which articulates the committee's approach to monetary policy, and on the committee's policy communication tools. The committee's 2% longer-run inflation goal will be retained and will not be a focus of the review. Our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. We will take on board lessons of the past 5 years and adapt our approach where appropriate to best serve the American people to whom we are accountable. We intend to wrap up the review by late summer. Let me conclude by emphasizing that at the Fed, we'll do everything we can to achieve our dual mandate goals that Congress has set for monetary policy. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Chairman Powell. Certainly your words and your actions have
You were listening to Fed Chair Jay Powell testify before the Senate Banking Committee. Now questioning him is Chairman Senator Tim Scott.
Economically, and I thank you for your commitment to having a conversation with all of us about how you do that well. You and I had a conversation yesterday. Some of it was frustrating, some of it was illuminating. But in the end, my goal is to make sure that the American people, and specifically those working paycheck to paycheck, have more opportunities to succeed, not fewer. You have said that the Fed is not against innovation, and banks are perfectly able to serve crypto customers as long as they understand and can manage the risks. Yet you have admitted that the threshold has been a little higher for banks engaging in crypto activities. Last week, I held a hearing on deep banking and once again heard that federal banking agencies, in particular the Fed, use reputational risk as a tool to encourage the debanking of certain legal industries and law-abiding citizens for political reasons not tied to safety and soundness. Debanking is a top priority for this committee, and it certainly is for me, and one that I believe is a bipartisan issue. Will you commit to working with this committee to end debanking, including working with the new Vice Chair of Supervision, once appointed, to revise the Federal Reserve supervision manuals to remove reputational risk as a tool to weigh in on political topics?
I'm happy to make that commitment.
Thank you, sir. Accountability is very important. I would like to think accountability is a priority for everyone, especially the Fed, given that failures in Fed supervision can result in the loss of billions of dollars. Yet following the failure of the Silicon Valley Bank, which was in part due to the failures of its regulators to identify egregious mismanagement of interest rate and liquidity risks, we have yet to see any regulators be held accountable. And as you recall, that was a point of my frustration. As a guy who spent a lot of time in the private sector, 15 years running a few businesses, I can tell you that accountability is a necessary part of making the entire organization healthier and perform its job as well as possible. I'm encouraged that the FDIC has begun the process of holding SVB executives accountable. That's good news. But no Fed employee has been fired, put on probation, put on performance improvement plan, all of which would be expected in the private sector, as I just mentioned, for employee failure. Please explain to me why Fed employees are held to a different standard from my perspective than everyone else, and what are you planning to do to take accountability for Fed failures in supervision?
So we've actually done quite a lot in response to the events associated with Silicon Valley Bank. So we've done many, many things. In terms of specific accountability, what we found was this was not a case of malfeasance or nonfeasance so much. It was a case of people were carrying out a specific playbook that failed to cause us to act in time for these things. So it wasn't actually particularly fair to the employees to say you violated our practices in some way. That wasn't really what happened. What happened was, I would say, a lot of focus on process and on governance and controls, and not enough focus on basic bread and butter banking, credit risk, liquidity risk, interest rate risk, things like that. So as we discussed yesterday, we took very substantial steps to avoid further spread of those issues, and that was successful. But I understand your point on accountability.
This is one of the areas where you see the approach of looking at safety and soundness, and with the number of MRAs that when really documented but no action was taken, that leads me to the conclusion that individual employees, supervisors, should have been held accountable for that. I'll move on, though. In the past, you've supported tailoring regulations so that we ensure banks of different sizes thrive and to preserve our diverse banking system. Will you commit to working with me as chairman to make sure that financial regulations do not impose more burden than is necessary? I'll say that this comes after a number of conversations with community banks and regional banks that have continued to stress that the cost of the regulatory framework around them isn't just harsh, it's oppressive. Larger banks suggest that the cost per employee for the regulatory framework is $10,000 per employee. I think we can do better, and would love to hear your thoughts on that.
Right, first of all, I will commit to working with you on that. We do try to avoid excessive burden. I think it's fair to take a fresh look on, frankly, on debanking. I think we all see, both in your hearing and in the one on the House side, we hear a lot of people talking about that. And, it's time to take a fresh look, I think. We don't intentionally do these things, but sometimes regulation leads things to happen, and we need to be working on that.
I appreciate that, and I'll turn it over to the ranking member. I'll say this, after having a number of conversations with CEOs of banks around the country, one of the things that was made clear to me was specific statement from the CEOs is that the regulatory OCC and other regulatory agencies said specifically to debank certain industries, and that is the point that I'm making, and one that I think we have to solve. If it's legal in America to do business, we should do our part to make sure that they're banked.
Thank you, Mr. Chairman. So over the weekend, co-president
You are listening to Fed Chair Jay Powell testifying before the Senate Banking Committee. Currently questioning Jay Powell as ranking member Elizabeth Warren.
Family of 4 in South Carolina facing an illegal foreclosure. No more cop on the beat looking out for your grandma whose bank account has just been taken over by a scammer. No more cop on the beat looking out for people getting ripped off by giant credit card companies that are charging illegal junk fees. It also means that the CFPB is no longer doing one of its most important jobs. examining big banks to root out illegal conduct before it happens, or at least stop it before more people get hurt. Chair Powell, if the CFPB isn't on the job right now, then who is administering JP Morgan or Wells Fargo's consumer compliance exams to ensure that they are following the law?
Senator, I believe that, and you would know, that Dodd-Frank moved all authority for examinations in the consumer space to the CFPB. We still have some jurisdiction.
We'll talk about that in a sec. But the answer to my question, please. If the CFPB is not there examining these giant banks to make sure they are following the laws on not cheating consumers, who is doing that job?
I can say no other federal regulator.
No one, in other words. So thanks to co-president Musk and CFPB acting director vote, Wall Street banks no longer have to show the bank examiners that they're not illegally opening accounts people didn't ask for, like happened with Wells Fargo, or charging illegal junk fees like the Bank of America did. But CFPB has jurisdiction only on banks that have more than $10 billion in assets. So what's happening in thousands of community banks all around the country, those that have less than $10 billion in assets? So Chair Powell, as you know, the Fed oversees consumer compliance for state member banks that have less than $10 billion in assets. Has the Fed suspended consumer compliance exams for those smaller banks, or is the Fed still on the job to make sure that those smaller banks are following consumer financial laws?
Still on the job, business as usual.
All right. By forcing the CFPB not to do its job, President Trump, Elon Musk, and the author of Project 2025, Russ Vought, are giving Wall Street banks an unlimited get-out-of-jail-free card so they can cheat working families, even while community banks continue to play by the rules. You know, for any Americans who have money deposited at JP Morgan or Wells Fargo or any other of the giant banks, they should now know that there is no one on the job to make sure that those banks are not scamming you. Only the smaller banks now have a cop on the beat to make sure that they aren't cheating consumers. You know, if I have my money in one of those giant banks, I might think about going to a smaller bank where the protection, at least right now, is a whole lot better. Now, at the same time that the CFPB is under attack, the Fed is buckling to pressure from Wall Street to erase other safeguards for the too big to fail banks. During the first Trump administration, under your leadership, the Fed weakened the big bank stress tests, including by giving the big banks some of the answers to the test in advance. I called you out on it, but you promised right here in this committee that you would not give those banks the whole answer key. I'm going to quote you back. You said, complete knowledge of the models could lead to a model monoculture in which all firms have similar internal stress testing models, which could increase the correlation of risk in the system and miss key idiosyncratic risks faced by the firms. I agreed with you. But several weeks ago, the Fed announced that it has plans to do exactly that, hand all of the answers over to the giant banks. Chair Powell, why is the Fed about to propose a rule that directly contradicts your own testimony and, in your own words, would render the stress tests toothless?
Senator, in essence, because the ground has shifted very substantially in administrative law, and we actually want the stress test to remain resilient to that. And so we're making changes to accomplish that.
Well, the changes are changes you've identified earlier as making those tests toothless. Look, the big banks are going to juice shareholder payouts and leave this economy more vulnerable to a crash. The Fed is knuckling under to bank lobbyists. We know how this ends. People will suffer. Wall Street will get bailed out. I urge you, Chair Powell, to serve Main Street instead of Wall Street. Don't weaken these rules.
Thank you. Senator Rounds.
Thank you, Mr. Chairman. And Mr. Chairman, thank you for coming before the committee. I appreciate the opportunity to visit with you. I've got a series of questions, but I would like to give you an opportunity.
You're listening to Federal Reserve Chair Jerome Powell being questioned by the Senate Banking and House Financial Services Committees. Republican Senator Mike Rounds is now speaking.
Individuals right now, any change in the laws regarding how they're supposed to be treating the individual consumers out there or anything along that line?
Law changes? No, I'm not aware of any
changes in any rules that they would have to follow?
Not that I'm aware of.
Are they still audited, and do they still have the regulators in watching all of their businesses just as they did before?
Well, they'd have all the regulators except for the CFPB.
Very good.
If in fact, in the hypothetical, the CFPB weren't carrying that out.
Anything else you'd like to add before we move on?
No, I'm good. Thank you.
Thank you, Mr. Chairman. As we continue to prioritize the stability and the resilience of our financial system, the ongoing Basel III rulemaking process has remained front and center in shaping our regulatory framework. I guess I was rather outspoken with my opposition to the original proposal, and further work was stalled at the end of the last year. I guess my question for you today, sir, is could you provide an update on the Federal Reserve's progress in finalizing the Basel III Endgame rulemaking process?
I'd be glad to. So we remain committed to completing Basel III Endgame. We think it's good for U.S. banks. It's good for our economy that there be a global standard beneath which foreign banks can't fall. And that was one of the big ideas behind the whole Basel Committee approach. So where it sits now is we await leadership arriving at the OCC and the FDIC, and that seems to be happening. And when that happens, we're going to sit down with them and work our way through to a Basel III Endgame proposal. And I think we can do this reasonably quickly, one that is compliant, consistent with the Basel requirements, and also consistent with what other large jurisdictions are doing. I'm optimistic that we can do that fairly quickly, and we're committed to doing that.
We always wanted our banks to be competitive with European banks, and I'm just curious, the original proposal that was in front of you, and I'd like your thoughts on this, it was estimated to increase our bank's capital by 19%, which I think may very well have created a potential disadvantage within the U.S. institutions versus our European counterparts. With any new proposal, what's your thoughts? Would you make a commitment that this would be a neutral approach with regard to capital?
The main commitment I'll make is we'll work together with new leadership at the other banking agencies to do something. But that's certainly, you know, I've said many times in this committee that I think that the level of capital in the largest banks is about right, and so it'll shake out somewhere in that area. I would guess. Our
expectation would be, and the markets would expect that it would be neutral with regard to capital
in that range. But I want to defer to our new colleagues and get their views as well. But that's a good starting place.
Okay, thank you. The Federal Reserve's partnership with the U.S. Treasury plays a central role in supporting our nation's payment infrastructure, which processes a vast range of daily transactions, from federal benefit disbursements to debt obligations. Could you outline the Federal Reserve's role in supporting and managing the Treasury's payment systems, including how the Fed works to keep these systems secure, efficient, and capable of handling the government's high volume of daily transactions?
So it's a complicated set of arrangements, and I'll try to summarize quickly. Effectively, Congress authorized spending, and then the agencies carry out those spending orders. And when the way they do that is they send an order to pay a payee, a recipient, to the Treasury Department. Upstream, before it gets to the Fed, all of these decisions are made about: is this an appropriate order? Is this payee on the don't pay list, and all those things. Once all of that is set, it comes to the Fed, and by that I mean 4 or so of the reserve banks, and we actually make the payment. We take the money out of the Treasury General account and we make the payment. We make no judgments whatsoever. Those are all made upstream from us, and we are in fact the fiscal agent of the Treasury.
Confirm for me today, is the system safe today?
I believe it is, and I will tell you, we are very strongly committed to the integrity, efficacy, resilience, and all those things of this system. And people do depend on this in a big way, and we're committed to that.
One last question for you, sir. The failure of Silicon Valley Bank, and the chairman brought this up. I'm just curious, recognizing a lot of banks out there looked at this. It cost the other banks in the system a lot of money to pick up the costs involved in the losses. Nobody's been fired. But you did indicate that it was a failure in the playbook. Has the playbook been revised, or can we expect that it will be revised?
In a lot of ways, it's been revised, yes. I can go into some details. I mean, one thing that didn't happen was, for example, the supervisors didn't follow through aggressively enough on things that they'd said. If they'd done that could well have been enough to stop it. But a lot of it was just not focusing enough directly on what was a very large amount of interest rate risk, a large portfolio of long-term securities matched up with an unstable funding base. And somehow people wrote about that, and not the Fed, but others wrote publicly about this, but somehow we don't expect bank runs outside of a crisis in this country, and that's what that was. It was a bank run, and bank runs are incredibly damaging. I think everyone learned a lot from that and is determined to do better.
Thank you, Mr. Chairman. I think this is one that I think, as you appropriately pointed out, I think this is an area where a lot more questions are out there yet, and I think if it's the playbook that was the problem, I think perhaps a discussion about how that playbook has been revised would be appropriate in the future. Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto.
Chairman Powell.
You are listening to Fed Chair Jay Powell testify before the Senate Banking Committee, currently being questioned now by Democratic Senator Catherine Cortez Masto.
Of concern, and you touched on a little bit of this, and I think this is important to clarify. There was a change in the law when the CFPB was created. The CFPB examines the banks and enforces the law, whereas the Fed only supervises those banks. Is that correct? Or how would you determine that relationship?
With the CFPB? So Dodd-Frank took a lot of the consumer compliance jurisdiction away from the other banking agencies and gave it to a newly created agency, the CFPB. We retained a residual amount of that, as we just discussed, which was banks under $10 billion in assets. But the CFPB essentially took all of that when Dodd-Frank came into being.
So as it was created, when you two were working together, the Federal Reserve collaborated with the Consumer Bureau when supervising those large banks, correct?
Yes, we still retain supervision over all the holding companies and also of Fed member banks.
And let me ask you this then, does the Federal Reserve enforce consumer protection laws now for things like money transmitters?
Not for money.
That would be the consumer protection. That would be CFPB.
Yes.
Okay.
That's
and
right.
so when we're talking about collaborating with the CFPB for financial technology firms, what would the Fed Reserve now do that if the CFPB, if the hypothetical is the CFPB no longer exists, what would be the Fed's role right now with respect to technology firms?
We don't have jurisdiction over, we have jurisdiction over banks and some financial market utilities.
So let me ask you this, because I know there's a number of Nevadans who file consumer reports of concerns about fraud and predators with the CFPB. The Fed Reserve doesn't receive those reports, correct?
No, I don't believe so.
And you have no role when it comes to consumer protection like the CFPB does, correct?
Unless you're a Fed member bank that has $10 billion or less in assets, then we have jurisdiction.
Right. So there is a gap. If the hypothetical is true, and what we're hearing that the CFPB is being shut down, there is a gap, what we're hearing in enforcement out there, and particularly when it comes to consumer protection. Is that, would you say that's true?
Yes, for all banks that we don't supervise.
And I think that's the concern we're all having right now, is this concern of when we're looking to streamline government. And listen, I'll be the first to tell you, there's a lot of bloat. We need to streamline it. We need to address regulations and overreach, but there's a strategic way to do it and not this burn down the house that is going to harm people across the country, including in my state, those Nevadans that are looking for some sort of enforcement around consumer protection law. So that's what you're hearing from many of us on our side of the aisle here.
Can I just very briefly add that we do have some residual enforcement authorities, but what we don't have is examination authority, and for the banks that the CFPB supervises.
Thank you. Let me ask you this, and we talked about this over the phone, and I understand it may be difficult to answer this, but the Federal Reserve Board members have been clear that future interest rate cuts are unlikely to happen despite the strong economy. But there are folks in my home that are in my state that are waiting to buy a home. And we know that's still an issue, the high prices right now for home affordability. You add the interest rates to it, it is a problem. So do you think it's most likely that interest rates will remain above 6% for this year, or can you even address that?
So overall, the economy is strong, growing 2.5% last year. The labor market is also very solid. Unemployment at 4%, quite a low level. Inflation last year was 2.6% for the year. So we're in a pretty good place with this economy. We want to make more progress on inflation, and we think our policy rate is in a good place, and we don't see any reason to be in a hurry to reduce it further. As it relates to housing, so it's true that mortgage rates have remained high, but that's not so directly related to the Fed's rate. It's really related more to long-term bond rates, particularly the Treasury, the 10-year Treasury, 30-year Treasury, for example. And those are high for reasons not particularly closely related to Fed policy. They may remain high. I think, once we lower rates and kind of rates return to a lower level, mortgage rates will come down. I don't know when that'll happen. And even when it does happen, we're still going to have a housing shortage in many places.
Thank you. Chairman Powell, thank you again for being here.
Thank you, ma'am. Next will be Senator Kennedy.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here.
You're currently listening to Fed Chair Jerome Powell being questioned by the Senate Banking Committee. Currently speaking is John Kennedy, Republican Senator.
To the big bank lobbyists. Is that true?
No.
Okay. It seems to me that the big picture should not go unnoticed. Do you recall a year or two ago when inflation was raging? I think its peak was about 9%. Many economists and other experts, based in part on history, said that you were going to have to provoke high unemployment and put our country into recession in order to get inflation down. Do you recall that?
Very, very well.
Are we in a recession?
We are not.
Would you, as an American, trade places right now with Germany in terms of the economy?
No, I sure wouldn't.
How about China?
No, wouldn't trade places.
How about France?
No, thanks.
Things aren't perfect. Inflation's obviously still sticky, and long rates are too high, which I want to talk about in a second. But the fact is, knock on wood, we have experienced a soft landing, haven't we?
Not for me to say, really. I'll let others.
Well, have we experienced a hard landing?
No, we sure
haven't.
Are
we in a recession?
No, we're not.
I call that a soft landing. And it seems to me that you and some of the ladies and gentlemen who are your colleagues at the Federal Reserve behind you deserve some credit for that.
Thank you.
I don't know why you don't take the credit. Everybody else in Washington, D.C. does. Again, I'm not saying things are perfect, but I never imagined that our landing could be this soft, albeit not perfect. And I wanted to thank you and your colleagues for that effort. You sure didn't get any help from Congress and our president on the fiscal side. I don't expect you to comment on that. You and the Federal Reserve can to a large extent control short rates, can't you?
Yes.
Through the Open Market Committee. You can't control long rates, though, can you?
No, we can't.
Why is that?
So a lot of things go into long rates, and one of them is the expected future short rate of Fed policy, but many, many other things go in. Expectations of inflation in the longer run, the sort of risks around the economy and around the budget deficit go into something called the term premium, which is the part we can't explain when we do these decompositions. And so, you know, it's set by supply and demand in the bond market at the long end, and we're not particularly. We have some influence, but mostly not.
Many Americans are looking at short rates and looking at the Fed's behavior and how you reduce inflation, but they don't seem they don't see the long rates going down, and obviously that affects mortgage rates. And I would encourage you and your colleagues to spend some time explaining to the American people why that is. Final question. If you went home tonight and Mayor Powell, your spouse, said, you know, I got a call today from our bank, and they're debanking us. They're worried about their reputational risk because they don't like our politics. Would you think that fair?
No, I sure wouldn't. And as I mentioned earlier, I too am troubled by the quantity of these reports, and you know, really want to understand better why this is happening. You know, one theory is that banks are just very risk averse around BSA and money laundering, and that's because we're so tough on them and that they just don't, any red flag is enough. But you know, it may be that this whole thing with reputation risk needs to be thought about. It's actually coming out of our one manual that we use. We're taking that concept out, the manual that we've been using for account access for master accounts. We're just going to take that out. But I think this needs a fresh look, and I think it's time for that, and we're gonna do that.
Well, I've asked our chairman, and he has agreed to invite some of the CEOs of some of the banks that have been debanking people. The CEOs,
yes.
Not their lawyers, not their PR consultants,
not the lobbyists,
not their priests, them. The CEOs to come in and let's talk about this and find out what the hell's been going on.
Thank you, Senator Kennedy.
Thank you, Mr. Chairman.
Senator Reid.
Thank you, Chairman Scott. Chairman Powell, welcome. Thank you very much. I think your monetary policy combined with the Biden fiscal policy over the last 4 years has made a tremendous difference.
You were listening to Fed Chair Jay Powell testify before the Senate Banking Committee. Currently questioning Powell is Democratic Senator Jack Reed.
2.2%. The unemployment rate finished the year at 6.7%. By 2024, gross domestic product grew 2.5%. The unemployment rate was 4.1%. Labor force participation rate went up from 61% to 62.5%. And that's a combination of your work together with the fiscal policy of the Biden administration. So I thank you for that. One of the issues before us today is the issue of tariffs. In July 2018 testimony, you stated, Mr. Chairman, countries that have remained open to trade, that have not erected barriers, including tariffs, have grown faster and had higher incomes. Do you still believe that?
Yes, I do. I would stand by that.
So President Trump's tariffs on China, Canada, and Mexico will obviously raise costs on families. In fact, some economists, many economists, project about $1,200 per year households will be paying extra, an increase of inflation by nearly 1%, economic growth depression, and, for example, the increase of the average car price by $2,700. Is that a wise policy?
So I guess I ought to say this. You know, I think the standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, you know, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Just this weekend, the president removed the board of the Kennedy Center and made himself chairman. What would you do if the president tried to remove a member of the Federal Reserve Board?
Well, it's pretty clearly not allowed under the law.
Thank you. We've communicated back and forth about synthetic risk transfer as a potential danger to the banking system. And could you give us some insights on how we can improve financial stability by regulating these transactions more appropriately?
So what we've been doing for some time now is looking at them on a case-by-case basis. And if they really do transfer risk successfully, then that's okay. I mean, you know, it's a good thing if a bank wants to transfer risk off its balance sheet in a way that it gets compensated for and all that. But what you want to make sure is that the risk is really transferred, and that was the problem during the global financial crisis. Was sort of things that appeared to but did not accomplish a transfer of risk. So we see this coming, and we've been looking at these transactions on an ongoing basis.
Well, I commend you for that. In fact, what happens typically is the transaction becomes complicated by synthetic risk transfers, as it was the case with synthetic derivatives. So thank you for your attention to that. We've talked about housing. It's absolutely critical everywhere across the country. We're in a housing shortage. Of course, while housing is difficult, two of the mainstays of our housing market are Fannie Mae and Freddie Mac, helping to support home ownership. Does the federal guarantee backing Fannie and Freddie help make mortgage rates more affordable and home ownership more accessible, Mr. Chairman?
I imagine it does hold down mortgage rates, the fact that they're a sovereign risk.
And how important is the 30-year mortgage to ensure that families can afford a home?
In our housing market, the 30-year mortgage is very important.
Yeah. And I have heard some discussions about eliminating Fannie Mae and Freddie Mac, which would be detrimental, I presume, to the housing market.
That's really a question for you. You know, I mean, putting them back in the private, putting housing finance back in the private sector has some appeal over the longer run, but I leave that with you.
Thank you, Mr. Chairman, very much. Appreciate it.
Thank you. Senator Ricketts.
Well, thank you, Mr. Chairman and Ranking Member,
You're currently listening to Federal Reserve Chair Jerry Powell being questioned by the Senate Banking Committee. Currently speaking is Pete Ricketts, Republican Senator.
I want to address, again, something that the Ranking Member started talking off about, which was characterizing the CFPB as being the cop on the beat here. But I can tell you, as having been a governor and having a Department of Banking that reported to me, that if any consumer would contact us and make a complaint about a bank, even a big bank like JP Morgan, we would investigate, as could the OCC, the FDIC, the FTC. So to characterize that nobody's out there looking for consumers, I think is inaccurate. And we ought not to try and scare consumers right now that somehow this is the case, because if you do have an issue, if you're a consumer, please reach out to your State Department of Banking, because those folks are going to look out for you. I can tell you that because I used to have one of those Department of Bankings. They did a fantastic job of looking out for the consumers. One of the things that has also impacted consumers is inflation. Prices under the Biden inflation were up 20%. An average household is paying $13,000 more today than they were for the same standard of living they had before Joe Biden got elected. We see that grocery prices, for example, are up 22%, rents up 23%. Simply put, Nebraskans are economically worse off today than they were 4 years ago, and I expect that that's part of the reason why we saw this change in the administration. They thought that that was not something that they wanted to continue to pursue. They didn't want the same policies being followed. We have to end the reckless federal spending, rein in inflation, and be responsible about how we make decisions to be able to grow the economy. One of those areas that I'm concerned about is the expansion of the Fed balance sheet. The Fed's balance sheet before, at the end of 2019, so before the pandemic, was about $4.1 trillion. By May of 2020, the Fed expanded that to $7 trillion, and by 2022, the Fed's balance sheet hit an all-time record of $8.9 trillion. Inflation peaked at 9.1% that year, a high we had not seen since 1981. Now, I'm encouraged by the actions the Fed has taken with quantitative tightening to shrink the balance sheet down to $6.85 trillion, but $6.85 trillion is still too high. And one of my concerns with this, Chairman, is that that's kind of one of your tools to be able to guard against a downturn in the economy or some sort of shock. You obviously used it during the pandemic. Looking ahead long term, will the Fed Reserve continue to this course of unwinding the balance sheet?
Yes, so what we said is that we intend to slow and then stop the decline when reserve balances are somewhat above the level that we judge consistent with so-called ample reserves. The most recent data and the feel of the markets is definitely that reserves are still abundant. They're about the level they were at when runoff started, because the runoff has really happened out of the overnight repo facility, reverse repo. So yes, it's an ongoing thing, and we're not yet where we're headed.
So what kind of pace can we expect? And I know that obviously there's going to be a lot of factors like what happens to the economy over the course of next year. But if things were going to go along the way they are today, you've already said the economy's doing well. Inflation's a little higher than we want it to be at 2.6%, but unemployment's at 4%. If these conditions, and I think you used the word stable quite a bit, if these conditions were to remain stable throughout the course of the year, would you have a range that you could give us of where the balance sheet might be if we were talking again here in January 2026?
Basically, we're going to be looking at reserve conditions in reserve markets, and trying to stop a little bit above what we consider ample. And we think we're meaningfully above that now. We can't put a number on it because you can't directly know the demand for reserves other than by observing behavior in the market and then putting a little bit of a buffer on it. So I can't give you an exact number, but for now it's ongoing, and we have a ways to go.
What kind of conditions would have to happen for you to start going back to quantitative easing?
So go to quantitative easing. That's a tool we tend to use when we're at the effective lower bound and we can't cut interest rates anymore. So nothing like what you're seeing in the current day. It's a different test for stopping quantitative tightening, but we would use QE going forward only in a situation where rates are at zero, and we're a long way from zero now.
So that you think that, again, just generally speaking then, if things were to remain stable, you'll continue to unwind the balance sheet, you'll continue the quantitative tightening. Can't give me a range on this? Is that what I hear you saying?
That's right. That's right.
Okay, great. Well, I encourage you to keep doing that because, again, I think that's important to be able to make sure that you've got powder for the next issue that we may face. So thank you very much, Mr. Chairman. Appreciate you being here.
Senator Warner.
Thank you, Mr. Chairman. Chairman Powell, good to see you. One of the things we've talked about in the past, and I've got 2 or 3 issues I want to get through fairly quickly, is that our
You were listening to Fed Chair Jay Powell testify in front of the Senate Banking Committee. He is currently being questioned by Democratic Senator Mark Warner.
That innovation can't come at the expense of things like anti-money laundering, consumer protection, financial stability. I continue to worry in many of these hearings where we keep seeing this regulatory creep outside the boundaries of traditional financial regulation. I think if we were starting a system from scratch, few of us would design it this way. But it is one of the reasons why I'm looking forward to working with Chair Scott and my colleague, Senator Lummis, on a framework at looking at stable coins in particular within the regulatory perimeter. I know my friend Bill Haggerty just introduced a bill in this area. I'm looking at trying to make sure we get those guardrails put in place, and how it touches the Fed is something that's terribly important to me. I know you and I have talked in the past about the notional idea of same activity, same regulation in the non-bank sector. If you'd like to wax briefly on this question around stable coins and how we think about them in the same point of, if they are similar to other activities, should they not have the same regulatory structure?
So we definitely support these efforts to create a regulatory framework around stablecoins. Stablecoins may have a big future with consumers and businesses. We can't know that now, but it is important for the development of stablecoins in a safe and sound manner, and a manner that protects consumers and savers and all, that there be a regulatory framework. So we see these bills, and we're in contact as we were in the last Congress, and trying to add our technical thoughts and how to do this. And we think it's a very constructive exercise.
Well, we do think, you have a lot of expertise in this session, and there are people people come with lots of opinions on everything in crypto, from over the top to the other end of the spectrum. And I'm gonna need to rely on your expertise as well as we try to work through some framework for stable coins. I know there are a lot of earlier questions on CFPB. I think the record is pretty darn good. It's returned $20 billion to consumers. Matter of fact, the last time we had the previous chair here, Chair Rohit, Mr. Chopra, we were talking about $55 million to Virginians. I do have to mention this more for my colleagues. Tim Kaine and I did a teletown hall last night. Lots of things happening in Virginia. Normally we would get maybe 3,000, 5,000, 6,000 folks on a teletown hall. We had 60,000 last night. I have not seen anything like that in my time up on here on the Hill, and a huge amount of concern about what the Doge boys are doing, whether our information is safe, whether privacy is protected. I had one lady say, in light of what was happening at CFPB, and while there's not a direct connection, she's saying, is her deposits at her bank safe? We tried to give her a assurance, but I said, you know what, ma'am, I'm going to be talking to the chairman of the Federal Reserve tomorrow. And with this diminution or shuttering, at least at the time being, of the CFPB, can I tell, I believe her name was Mary, can I tell Mary from Virginia that her bank account is safe?
I think bank accounts overall across the economy are safe. Yes, we've still got deposit insurance at the FDIC, and the banking system is well capitalized and safe.
Well, again, I think the concern was being raised was that the diminution of consumer protections lent her concerns about whether that dollar being safe. Last thing I want to recognize is that, there's been reports in the media about the thinness in the Treasury markets, the number of additional bonding that we're going to have to do, particularly with so many of these unpaid tax cuts. Matter of fact, one of the things that was really striking to me was that yesterday the president mentioned how he was, quote, examining Treasury debt payments for possible fraud, and suggested that our debt might not be as high as possible. We all understand the full faith and credit of the United States is based upon a reputation. If this president were to suddenly say, I'm wiping off X amount of debt because I don't believe we owe it, what kind of effect would that have on both stability of the dollar and the overstability of our economy?
It will probably not surprise you that I will defer to you on that question.
So you think it would be, from a Fed standpoint, the President of the United States starts to saying we're not going to pay our Treasury debt, you're going to have no view at all?
I'm not going to comment on things that the president says.
I I would like to see us at some point get a stronger answer on that, because I think that in light of the president's willingness to shut down agencies willy-nilly, his ability to potentially curtail payment of debt, I think would have devastating consequences on our economy. Thank you, Mr. Chairman.
Senator Britt.
Thank you, Mr. Chairman. Obviously, there's been a lot of conversation both in
You're
and
currently
out of this
listening to
hearing
Federal
room today.
Reserve Chair Jerome Powell being questioned in front of the Senate Banking Committee. Currently speaking is Republican Senator Katie Britt of Alabama.
President Trump ran on this. I mean, he said we're going to look for wasteful spending across our government. We're $36 trillion in debt, y'all. That's not only fiscally irresponsible, it is actually morally irresponsible. And the difference in this administration and the last administration is that President Trump is actually the final arbiter. And it's interesting that none of you had anything to say over the last 4 years when it is clear that our commander-in-chief was not in command. And if we're going to use the term co-president, then let's go back and say co-president Jake Sullivan, co-president Ron Klain, co-president Jill Biden. I mean, it seems that some of the biggest decisions were made during the president's afternoon nap time. And so I just think we need to be a little bit more honest about what's been laid out and what's actually occurring. Chair Powell, I want to discuss some monetary policy issues, but I first want to highlight a few supervisory items. We unfortunately started 2023 with several bank failures in which the Fed itself admits its supervisors were, quote, too slow to ask. The question has been asked earlier about who was fired, who was not. I think that there's some real merit to having accountability that we have not seen there. In the aftermath of those failures, the Fed was certainly not slow to act when it came to new regulations, like the new capital requirements that would have put the U.S. banks at a global disadvantage and actually hurt consumers in my state. The way I look at this is the world came up with a gold standard. And then Vice Chair Barr said, hold my beer. And unfortunately, that hurts Alabamians. In addition to that, we had Community Reinvestment Act and stress testing frameworks that were basically adopted in secret. Or as we discussed last week, the reputational risk and just the arbitrary nature of that and those standards that were used to push political agendas. None of this is acceptable, and we've got to take a look at how to promote greater accountability and transparency into the Fed's supervisory function. Shifting gears, as of January 30th, the Federal Reserve had a mark-to-market loss on its balance sheet of roughly $221 billion. In fact, I looked back and the Fed has posted losses since September of 2022. Meanwhile, we've seen transfers to the CFPB totaling $2 billion since September of 2022. So just to clarify, Chair Powell, these money transfers are requested by the CFPB director each quarter and then directly deposited by the Fed. Is that how that works?
So the director of the CFPB requests money, and we, under the law, we send that money. Yes.
So, in fact, but Dodd-Frank actually prohibits the Fed from actually reviewing or amending those requests.
That is correct.
And so it gives full discretion to the CFPB director.
Up to, I think, 12% of our, there's a ceiling on that, but that's correct.
So just to level set, how many times, has the CFPB funding request been denied by the Fed?
We don't have the authority to deny it under the law.
Zero, right?
Zero, yeah.
Yeah, that's what I thought. And by the way, I'd like to applaud the current administration and acting director Vogt for inserting some accountability back into the agency by pausing these quarterly just blank checks. On that, I know there's been a lot of conversation